Is 10 minutes late too long? Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is titled The Annual Report of the Financial Stability Oversight Council. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I'll note at the outset the hearing has a hard stop at 1 p.m. Thank you, Secretary Yellen, for being here. I'll now recognize myself for 4 minutes to give an opening statement. Thank you, Secretary Yellen, for being here today and your capacity as chair of the Financial Stability Oversight Council. FSOC's purpose is straightforward: to identify risks that could impact our financial stability, promote market discipline by eliminating expectations of bailouts, and respond to emerging threats. FSOC's name pretty much sums up its mission. And yet, under the current leadership, we've seen FSOC expand its regulatory reach to fit the administration's political priorities. That's unfortunate. And unfortunately, FSOC appears to be a part of the same troubling trend as Biden's other financial regulators. When you're distracted by shiny partisan objects, you take the eye off the ball. For example, aside from a stale mention of interest rate risks in 2022, the annual FSOC report of that year, the FSOC did nothing to identify the emerging instability that set off the March 2023 banking sector turbulence. And indicators produced by FSOC's research arm, the Office of Financial Research, showed no signs of emerging risks, even as the risk was indeed emerging. Secretary Yellen, we remember the panic Americans experienced in March. I commend you for your willingness to engage in stabilizing the markets. I think that with your credibility lent a lot of effort to the administration. And at that time, we worked together to quell concerns and provide a level-headed response in an uncertain time. The goal was to do no harm and regain stability without injecting politics, and I think we achieved that. A goal that President Biden clearly did not share when he took advantage of the situation to blame Republicans for what was a widely bipartisan regulatory reform law enacted a few years ago. In real time, many members of this committee stood behind regulators' emerging actions with the expectation that we and the public would receive a full accounting of the decisions made that week. Now, nearly a year later, we do not still know the full story as FSOC and other administration officials have been less than transparent. To be clear, this does nothing to calm the nerves of an already skittish consumer. And with issues still plaguing some regional banks, it's irresponsible for this administration and fellow regulators to continue to stonewall. While Republicans have worked to get the answers the American people deserve, FSOC has been busy making changes to enable it to serve as a roving regulator, something architects of the Dodd-Frank Act vigorously promised FSOC would not be. This includes relaxing the criteria used to designate non-bank financial companies as systemically important and putting them under Federal Reserve regulation. This proposal is based on the premise that our financial system would be best served with more oversight and control by the Federal Reserve, even beyond banks. It's important to note that the gross incompetence of the Federal Reserve and FDIC supervision is what led to the bank failures in March. However, prudential regulation is grounded in mitigating the specific risk that bank activity poses. These regulations are not necessarily appropriate for institutions that may engage in different activities and therefore pose different risks. Given the significant consequences associated with the systemic risk designation, Congress did not intend for this designation to be politicized nor weaponized. This move, taken with the apparent failure to identify and respond to emerging risks, calls into question the effectiveness of the Financial Stability Oversight Council. Secretary Yellen, I would encourage you and your fellow regulators to get back to the work you've been tasked with. We've already experienced what happens when you take the eye off the ball and get engaged in politics. The American people should not have to suffer through that again. I yield back. I now recognize the ranking member, Ms. Waters, for 4 minutes.
Thank you, Mr. Chairman. Treasury Secretary Yellen and President Biden's economic team have been hard at work to turn the tide on the disastrous economy that the twice impeached, 4 times criminally indicted former president left us. The numbers show their hard work is paying off. In 2023, the unemployment rate remained below 4%, and the economy created a whooping 2.7 million new jobs, more than any year of the Trump administration. Inflation has fallen to the pre-pandemic level of 2% over the last 6 months. 16 million small businesses have been created, and twice as many Black households now own a business. Workers' wages and wealth are higher now than before the pandemic began, with income up nearly 4% last year after adjusting for inflation. To top it off, consumers' confidence is returning to our nation's economy, and they are shopping and traveling again. There is currently more work to do to address the housing affordability crisis, but the Biden administration has masterfully guided the United States to the fastest economic rebound from the pandemic of any wealthy country in the world. Of course, this progress would not be possible if it were not for Secretary Yellen's strong leadership and that of President Biden's banking regulators, who decisively prevented harm to our financial system after the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. Make no mistake, the seeds of that banking crisis were planted by Trump and his bank regulators' deregulation of regional banks. Less than a year later, it's a shame that Republicans have teamed up with Wall Street to spread misinformation and to try and block efforts to strengthen capital at our nation's biggest banks. Wall Street is peddling lies about what's needed. The needed capital reforms will do, going as far as taking out expensive TV and social media ads and even setting up a website to purportedly educate the public, except it is filled with misleading claims. What they don't want you to know is that the only people who benefit from lower capital requirements are the wealthy bank executives. Less capital means consumers are left more vulnerable, especially in a downturn, while bank execs take home bigger bonuses each year. Lower capital requirements also mean that taxpayers are more likely to be called on to bail these banks out when they run into trouble. Let's be clear. Research overwhelmingly shows that well-capitalized banks lend more than other banks in good times and in bad. I'm sure the Secretary will set the record straight about how these capital reforms will ensure first-time home buyers, small business owners, and communities of color looking to build wealth can better access credit and prevent future bank crises. Finally, I want to applaud the Financial Stability Oversight Council for updating its designation procedures to ensure the Council can use all of its tools to protect our economy. I also applaud the Council for continuing the work Committee Democrats started by guarding us against risk from artificial intelligence, cryptocurrencies, and climate change. I'm so proud to see Secretary Yellen here today. Thank you for all that you've done in your leadership, and I look forward to today's hearing, and I yield back the balance of my time.
We'll now recognize the chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, for 1 minute.
Secretary Yellen, the 3 statutory purposes of the Financial Stability Oversight Council and Dodd-Frank are to identify stability risks, promote market discipline by eliminating bailout expectations, and respond to emerging stability threats. Last March, FSOC did not identify a systemic risk as it emerged, did not promote market discipline as 100% of large uninsured deposits were bailed out, and did nothing to respond to the emerging stability threat. Nothing would have been different if FSOC had never been created. FSOC has not fulfilled its statutory purposes. Instead, it is an unaccountable roving regulator ensnaring private firms into the regulatory net using new designation processes that remove analytical discipline. We are left with an FSOC used to pressure nominally independent financial regulators into whatever policy objectives the Biden administration wants to push into the regulatory framework without legislative authority. The current FSOC is poised to operate as a partisan body and a rogue regulator, which is not what is statutorily intended in Dodd-Frank. Or maybe it was intended to act that way, and we don't like it. And we look forward to your testimony today. I yield back.
Gentleman yields back. We'll now go to the chair of the Financial Institutions Monetary Policy Subcommittee, the ranking member, Mr. Foster, for 1 minute.
Thank you, Chair McHenry. Secretary Yellen, thank you for joining us today and for your leadership of the Treasury Department. Since the Dodd-Frank Act created FSOC in 2010, it's been a vital forum for U.S. financial regulators to share information regarding systemic risks to our economy. FSOC's comprehensive view of the financial system is critical because systemic risks rarely develop in ways that fall entirely within the jurisdiction of a single agency. This year also marks the first time that artificial intelligence has been listed as a vulnerability in FSOC's annual report, and I'm happy to have seen the steps that financial regulators have started to take to address AI-related risks since President Biden's executive order on AI was issued last fall. While AI presents many opportunities to make our financial system stronger, deepfake impersonations have the potential to supercharge financial fraud and cybersecurity risk by making it harder to identify the real identity of the person on the other end of a call, a video, or an internet connection. The response to emerging issues like these should not take place in a silo, and I'm happy to see FSOC recognize the importance of holistically addressing these and other emerging risks. Thank you, and I yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Janet Yellen, Secretary of the Department of Treasury. I will not go into your full bio, but suffice it to say she's held every significant economic post in our government. We welcome your testimony today, and thank you for being here. You'll be recognized for 5 minutes for oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. You're now recognized for 5 minutes. Thank you.
Thank you. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for inviting me to testify. Over the past 3 years, the Biden administration has driven an historic recovery. GDP growth is strong and inflation has declined significantly. We've also achieved a healthy labor market. The prime age labor force participation rate is up by over 2 percentage points from January 2021. The unemployment rate remains below 4%, continuing the longest streak in 50 years. Real wages have increased. Household median wealth has too, by 37% between 2019 and 2022. That's the largest 3-year increase on record. Families are now putting their additional income and accumulated savings back into the economy. Our continued economic strength depends on a solid and resilient U.S. financial system. Throughout 2023, the Financial Stability Oversight Council monitored a wide range of risks, including risks stemming from commercial and residential real estate sectors and from global geopolitical conflicts and technological developments. When 2 regional banks failed last March, we acted quickly to prevent contagion to banks with similar vulnerabilities and to maintain confidence in the banking system. The Council also increased transparency this year, issuing an analytic framework that for the first time provides the public with in-depth information on how it monitors, assesses, and responds to potential financial risks. Let me now highlight 5 areas of ongoing work that are further detailed in the Council's 2023 annual report. First, the Council is focused on risks from the banking sector. and from non-bank financial institutions. It supports member agencies' plans to review whether capital measures appropriately reflect a banking institution's ability to absorb losses, improve resolvability at large, complex, or interconnected banks, and address vulnerabilities from uninsured deposit levels and depositor composition. Non-bank financial institutions are an important source of capital in financial markets, but also pose potential risks to the financial system, including risks related to liquidity mismatch and leverage. Securities and Exchange Commission initiatives focused on hedge funds, money market funds, and other investment funds are an important step forward here. Second, the Council is focused on member agencies enhancing assessment efforts and increasing coordination around climate-related financial stability risks from increasingly severe and frequent climate-related events. Financial regulators should also continue to promote disclosures that allow investors and financial institutions to consider these risks in their investment and lending decisions. Third, a key focus has been bolstering protections against cybersecurity risks. The Council promotes sharing timely and actionable cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiencies, and potential risks like cyber and model risk. Financial institutions, regulators, and market participants should continue deepening their expertise and monitoring capacity in this area. Fifth, the Council is focused on digital assets and related risks, such as from runs on crypto asset platforms and stablecoins, potential vulnerabilities from crypto asset price volatility, and the proliferation of platforms acting outside of or out of compliance with applicable laws and regulations. Applicable rules and regulations should be enforced, and Congress should pass legislation to provide for the regulation of stablecoins and of the spot market for crypto assets that are not securities. We look forward to continuing to engage with Congress on this. With this overview, I look forward to taking your questions on these and other areas.
Thank you, Secretary Yellen. I'll recognize myself for 5 minutes. And so let's begin with your last point on the regulation of the spot market for digital assets. This committee has produced 2 bipartisan bills, one on stablecoins, one on market structure to regulate the spot market of digital assets and provide this clarity between the CFTC and the SEC. So you testify that FSOC's view is that we need federal law and law changes on the spot market. Can you tell us why? Can you describe why? That's FSOC's belief.
Well, there are many areas with respect to digital assets where we do have clear regulatory authority, but we've identified some gaps where for consumer investor protection and to address financial stability risk, it would be very useful for Congress to take action to fill those gaps. And the CFTC, for example, doesn't have supervisory or regulatory authority with respect to spot markets and commodities like Bitcoin. So that's a regulatory gap. Furthermore, stable coins pose risks to the financial system that both FSOC and the President's Working Group on Financial Markets have identified as potentially becoming significant over time, and we would very much welcome an effort by Congress to create a regulatory framework that would be appropriate to address those risks.
So similar to, so stable coins are now being regulated by the states. New York has a very resilient regime. Are you suggesting something like the New York regime would be applicable to fix this problem?
Well, FSOC believes that it's critical for there to be a federal regulatory floor that would apply to all states, and that a federal regulator should have the ability to decide if a stablecoin issuer should be barred from issuing such an asset. Also, we believe that because wallets are a critical part of the stablecoin ecosystem, and we've seen many instances in which there have been significant losses, that it's critical to enact regulatory protections for holders of wallets.
So back to the spot market, though. As in your report, you state clearly that we need to change law for us to have proper regulation of the digital asset spot market. Is that correct?
Yes, that's a recommendation.
Okay, so broader. Let's go to the broader set, not the emerging issues. But in November, FSOC issued its final guidance on non-bank designation. Are there firms that FSOC has identified that are being analyzed right now for designation?
Well, I don't think it's appropriate for me to talk about individual firms. We've certainly not reached a stage at which the council has taken any action or received recommendations with respect to designation. We did put out, as you know, you mentioned, revised guidance pertaining to non-bank designations, and we published an analytic framework, but we wanted to make sure that our entire toolkit that Congress gave to FSOC is usable. There are many tools in that toolkit, and the analytic framework recognizes that designation is only one of those tools. It's not in any sense the preferred tool. It really depends on the specifics of the financial stability risk.
What many of us have highlighted is the fact that that is such an opaque process that it leads to greater instability, greater uncertainty in the marketplace. But let me finish with this, the overall economy. As Fed Chair Powell was interviewed this past weekend on 60 Minutes, and he says that the American people, they have a right to be unhappy. The cost of food is dramatically up under your tenure as Treasury Secretary in this administration. What do you say to the American people that are unhappy with paying more for the basics of life?
Households have been struggling through the pandemic with many burdens, including a higher cost of food and some increase in gas prices. We've had a couple of years of high inflation, and it's a top priority of this administration to bring inflation down and to use the tools we have to reduce the burdens on hardworking households. We've certainly used it with respect to healthcare costs, limiting insurance premiums for healthcare, the co-pays for insulin.
My time has expired. Thank you for your testimony. I yield to the ranking member, Ms. Waters.
Thank you again, Mr. Chairman. Secretary Yellen, I again want to applaud your excellent work and that of the Federal Reserve and FDIC to quickly act last spring to contain the damage from the sudden failures of Silicon Valley Bank in my state, Signature Bank, and First Republic Bank that could have spiraled out of control into a costly financial crisis, a recession, and corresponding layoffs, foreclosures, and lost savings for millions of people. Of course, some of us warned about Trump's deregulation efforts in S-2155, a Republican bill that Trump's regulators used to reduce capital and other requirements for regional banks like SVB. In fact, it allowed Silicon Valley Bank to opt out of maintaining nearly 2% more capital for their book of securities that had a large amount of unrealized losses when the federal government raised interest rates. When SVB was forced to sell those securities at a steep loss, it alarmed customers, resulting in the fastest bank run in the United States history. Since then, Republicans have tried to claim that capital had nothing to do with the bank failures, but their own witness, Margaret Tyree from Davis Polk, testified that SVB's capital shortcoming was a problem and she supported efforts to fix it. I'm so happy our federal banking regulators have issued proposals to fix this issue and otherwise strengthen capital requirements for the largest banks. The Financial Stability Oversight Council urged regulators to finalize these bank capital rules in its annual report. Would you briefly try and explain to members why the bank capital proposal is so important for financial stability?
Well, it's really critically important to the safety and stability of our entire financial system for there to be strong standards of capital liquidity and risk management for banks, especially for the largest banks. And the banking regulators have proposed new rules to address these risks and to implement an international agreement on Basel III. I would say that the proposals are out for comment, and it's really up to the banking regulators to decide on the appropriate specifics.
Thank you, Madam Secretary. Unfortunately, I want you to know that the mega banks are working overtime to try and kill the bank capital proposal, claiming, among other things, that it will limit their ability to make loans to communities of color that they already rarely serve and routinely have discriminated against over the years. But capital is not something that's locked away, but rather it is a source of funds that banks can redeploy. In fact, research shows that better capitalized banks actually lend more, not less, to consumers in both good times and bad. Secretary Yellen, will lending come to a halt if regulators implement their capital proposal? Did you hear similar industry attacks when you were at the Fed helping implement the Dodd-Frank post-crisis reforms?
Well, I think what we found during that time was implementing strong capital liquidity and risk management rules led to a stronger banking system that was better able to meet the needs of borrowers throughout the country. And I think we saw the benefit of that when the pandemic struck. And the bank, well, there were many financial stability risks that did materialize. The banking system was strong and able to meet the credit needs of the country's businesses and households.
Secretary Yellen, do you recall the weekend that all of the regulators and so many people were involved in after the failure of Silicon Valley Bank to try and save this country from experiencing a bank run that could have actually crippled our banking system? Do you recall the work that went into that? 24 hours a day for 3 days, so that when we woke up on Monday morning, we were safe, rather than we were going to get back to what happened back in 2008. You remember that?
I will never forget it. I was involved in it, and we did everything we could to put together a package of measures that would stop what could have become a run on the banking system, to the huge detriment of our economy and to hardworking Americans and businesses.
And again, if there had been adequate capital at Silicon Valley Bank, we could have avoided what took place in the way that it did.
Well, there was an issue with their management of interest rate risk, which had produced mark-to-market losses on long duration assets that they held. And that was coupled with very heavy reliance on uninsured deposits that were concentrated among a group of tech firms that were active on social media. We saw a run that was the largest and fastest of anything anyone has ever witnessed in this country.
Thank you very much. You support 2% increase in capital for all of the biggest banks.
I'm going to let the banking regulators decide what the
Gentlelady,
right thing
Thank you.
is.
Thank you.
We'll
Yield
now
back.
go to the Vice Chair, Mr. Hill, for 5 minutes.
Thank you, Chairman, Madam Secretary. It's nice to have you back in the committee. We're grateful to have your expertise. Last time we were together, we talked about the subject that Chairman McHenry brought up, which is FSOC's recommendations on stable coins and the spot market. And I was very pleased to hear your testimony on that, reiterating that Congress does need to take action there. And I'm proud to have worked with the chairman and my Democratic colleagues on bipartisan bills to do precisely that. With that said, Madam Secretary, as chair of FSOC, what have you done to encourage the SEC and the CFTC to work together in these areas to make these bills stronger and, cooperate together to make our work here in Congress go more smoothly? Have you had a meeting with the chairman of the SEC about stable coins and the digital assets regulatory framework?
Well, the President's Working Group on Financial Markets produced a report.
Yes, ma'am. We've read that report thoroughly. I'm talking about in recent months, since June and July last year, for example, when we marked up this bill in July. Have you worked with Chairman Benham or Chairman Gensler on this legislation? Have you talked to them about it?
I mean, I've talked to them often over the last couple of years about stable coins, and I'm not sure if I've talked with them over the last couple of months on this topic, but we've had many conversations.
Another area that I think Chairman Gensler has stumbled in is his proposal on custody, which the bank regulators like the Comptroller of the Currency and the Federal Reserve don't support. Many of us on this committee are concerned about that. Do you support the SEC's rule on custody as proposed?
We have had some concerns about how it would impact banks, and that's something I have discussed with the chairman.
Thank you, Madam Secretary. Let me turn to the CFPB Director Chopra is suggesting that FSOC use for the first time ever Title VIII authority to address payment clearing and settlement activities. For example, he's proposed considering designating certain non-bank payment platforms as systemically important. Do you support that?
We've not taken a position on that. What I've said is that I think it's important for Congress to address this issue. We've made recommendations, and we think that is by far the preferred approach. And I've not looked into other alternatives. We stand ready to work on a bipartisan basis with you to take this on.
Thank you. Well, for example, would you agree with the director that peer-to-peer payment activity or non-bank peer-to-peer payments represent financial stability risks to the financial system overall? Zelle, Venmo, you think peer-to-peer payment systems present a financial stability risk to the system?
I don't believe that's something that FSOC is highlighted, and
I think the issue, I want you to reflect on that. I'd be happy to have your views in writing on that. But I think some FSOC members may not be viewing the designation of a non-bank activity as really a last resort, that we have regulatory systems and other rules to handle that. And I think this is a particular case. For example, do you think the Fed, having been the chair there, has sufficient expertise, knowledge, and supervisory authority to deal with companies in different industries, like asset managers or cloud providers or big tech companies, if they were to be designated under that sort of an idea?
I do want to make clear that there's nothing about FSOC's approach that places designation as a preferred approach. There are many tools and only certain situations in which it would be appropriate. Congress designated in Dodd-Frank that if a company whose material distress poses severe threats to financial stability, the Fed should be the regulator. And I certainly remember from my time there when several insurance companies had been designated that the Fed built substantial expertise to
Thank you, Madam Secretary.
carry that out.
Gentleman yields back. We'll now go to the gentleman from California, Mr. Sherman, for 5 minutes.
You play an important role on foreign policy. I hope in dealing with the IMF, you make it clear that our support for Pakistan's request is focused on the fairness of their elections and human rights and democracy in Pakistan in general. I hope you'll do everything possible to make sure that any change at the IMF does not give Iran additional special drawing rights or allow them to use their existing special drawing rights to turn into currency that they can use. And finally, I hope that we see sanctions against the individuals Human Rights Watch has identified with the Amhara regional forces in northern Ethiopia, and that you'll focus on Eritrea's terrorizing of the Tigray region of Ethiopia. On taxation, I want to commend you on the direct file program, but you can go a step further. Senator Warren and I have focused on the 36 countries where they send you a pre-populated return. And you can just click yes, or you can change it. And of course, it's voluntary. You don't have to look at it at all. And I look forward to the day when the vast majority of taxpayers can just click yes, or maybe add the name of a newborn child and be done with their tax return. On crypto, you were instructed by the Infrastructure Investment and Jobs Act to have the rules enforced for the 2023 tax season. They're not enforced. So you're behind on rules designed to enforce taxation on crypto transactions. But I want to focus your attention on the capital gains allowance. We provide at very great cost to our Treasury an incentive for investors to invest in stocks, chiefly, also real estate, because we want to build our economy. And there's arguments as to whether it's very effective or only slightly effective, but the reason for capital gains allowance is to encourage investment that builds an economy. Can you think of a reason why we would, at our cost of the U.S. government, incentivize people to invest in the Chinese economy? Why do we provide a capital gains allowance for investing in Chinese stock? Is there any reason you can think of?
Well, in general, we've made a decision that capital gains should be treated similarly and only taxed when they're realized.
Well, I'm not talking about realization. You sell a Chinese stock at a profit. You pay a lower tax on that than your assistant pays on his or her earned income. Now, that's to encourage you to invest in the stock. Why do we want to, is there a national purpose in encouraging Americans to invest in Chinese equities that you're aware of? Because I'm not.
Well, I mean, in general, I think the view has been that both inward and outward investment are economically beneficial. There certainly
I'll want to
can be
move on to
cases-
another issue,
there
but
can be cases
encouraging the building of the Chinese economy is not thought by most members of Congress to be a good use of federal funds. On bank regulation, there's no easy answer. If our standards are too low, we could see the need for bailouts as we did in 2008, which not only shakes the economy, it shakes the social fabric of our society. But if those standards are too high, we lose economic growth and we move money away from banks, which do an inadequate job of lending to small businesses in our districts, over to Wall Street, where they don't even, for the most part, pretend to do the job of investing in small businesses in our districts. We have the possible designation of SIFIs. When I was here and we crafted that definition, the thinking was some companies have such liabilities that if they go bankrupt, it destroys the whole economy. Is there a reason why you're focused on identifying as SIFIs entities that don't have substantial liabilities, such as mutual funds and money managers?
I'm sorry, is that we're certainly focused on the entire financial system. FSOC is not only on banks.
Right, but is your why would you designate an entity that doesn't have substantial liabilities?
We would only designate an entity if FSOC determined that its material distress would pose a severe threat to the financial stability of the United States.
Thank you very much.
The gentleman from Oklahoma, Mr. Lucas, is recognized.
Thank you, Mr. Chairman. And Secretary Yellen, thank you for testifying today. During our discussion when you were here last before the committee, the Basel Endgame proposal had not been officially proposed by the banking regulators. And since then, over the past 6 months, there's been a robust response to the overwhelming negative consequences of the proposal. I'm concerned that the Basel Endgame will undermine many of the steps taken by Congress to strengthen the financial system and support the economy. One example I have focused on is the impact on derivative end users. Back in 2010, I sat on the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, like farmers, ranchers, small businesses. This has a long history of broad bipartisan support. Unfortunately, both of the proposals from the Federal Reserve will drive up the cost of hedging for end users and undermine the long-standing work done by Congress and this committee. And this is just one example of how the Fed's proposal moves us in the wrong direction. Secretary Yellen, at some point in the months ahead, the banking regulators will vote on a final rule. When we last discussed Basel Endgame, you said that Treasury would have the opportunity to provide feedback on this proposal. Given Treasury's mission, which is to maintain a strong economy and promote economic growth, has Treasury provided feedback to the Fed, number one? And number two, are you confident that the proposal will not undermine the resilience of the U.S. capital markets that are so critical to the economy?
So I'm not aware that Treasury has provided any formal feedback to the Fed on the Basel regulations. As you know, they've received many comments expressing concern about a number of different proposals that were embodied in the Basel III package. And I know that all of the banking agencies that publish that are considering how to respond to those comments and concerns in trying to craft a final rule.
Well, are you concerned that the proposal will undermine the resilience of the U.S. capital markets?
I'm not going to take a position on the details of the rule. I would just say again that I believe that there should be strong capital and liquidity standards to ensure that these institutions operate in a safe and sound manner. but it's up to the banking agencies to evaluate the specifics.
So it's fair to say that whatever concerns might be at Treasury don't rise to the point of providing feedback, okay? Another aspect of the Basel Endgame is the impact on the U.S. Treasury market. Consumers, businesses, governments, the global financial system depend on a well-functioning U.S. Treasury market. And of course, a healthy market for U.S. Treasuries is essential for U.S. government operations. However, the proposal from the Fed could cause banks to pull back from the market-making activities in the Treasury's future markets, which would raise costs for market participants. At the same time, just this past December, the SEC, the Securities and Exchange Commission, finalized a rule that would increase central clearing for Treasury markets along with other reforms. So you have the increased cost coming from the Federal Reserve, you have the significant market structure reforms coming from the Securities and Exchange Commission, all impacting U.S. Treasury market at the same time. I just worry that this could create a huge problem. So, Secretary Yellen, how have you engaged the SEC and the Fed to evaluate the cumulative impact of the proposals, and how can we be sure that there will be no significant market disruptions? Turbulence may be about a better word for it.
Well, we've formed an interagency working group that includes all of those agencies and Treasury and the New York Fed to focus on the resilience and operation of the Treasury market. It's critically important to us that the Treasury market is well-functioning, deep, liquid, and can enable the dollar to be the most secure asset of any in the world. And they are looking at specifics, including improved disclosure. They have taken the view that increased central clearing can make the Treasury market more resilient, and they're considering many factors.
The gentleman's time has expired.
Chairman, my time has expired, but not my concerns.
Thank you. The gentleman from Georgia, Mr. Scott, is recognized.
Secretary Yellen, in its 2023 annual report, FSOC identified several market vulnerabilities related to commercial real estate lending. FSOC specifically identified significant concentrations in the commercial real estate for many of our regional and community banks as a risk to our entire banking system, which means our entire economy. And I want to ask you your thoughts on that. And you went a little bit further in that report, and I quote, "The vulnerabilities to the regional and community banks are negative trends in the office market and an erosion in high multifamily property values." Now, Chair Yellen, we're talking about the backbone. These communities and regional banks are the backbone of our banking system for most of the American people. So my question to you is, given that the commercial real estate loans are the largest loan category for half of U.S. banks, and that 1/4 have commercial real estate loan portfolios that are significantly larger relative to their capital reserves, Secretary Yellen, should we not be concerned that a spillover effect could lead to banks lending less to other very important sectors of the economy, like our American people?
Well, thank you for that question. commercial real estate is an area that FSOC focused on in its annual report. And it's something that the Financial Stability Oversight Council addresses in its meetings on a regular basis. Because, as you mentioned, many, especially smaller and regional banks, have concentrations of commercial real estate lending. I think office properties in some cities are of special concern because vacancy rates have increased and there have been declines in property value.
Yes, and my time is slipping by, but I've got to ask your opinion on something that is very, very important to me, and that is the implementation of this Basel III endgame proposal. As you know, the largest banks would be required to hold more capital for their actual risk-taking, and I remain deeply concerned that this will further diminish the credit capacities and weaken the economic conditions of our American people. Tell me your thoughts on this Basel endgame business.
So the banking agencies, I know, have received many comments that have expressed this concern, and the heads of those agencies, the financial regulators, have expressed a commitment.
But I want to know, I have such respect for you and your economic genius and prowess in the financial system, and I think the majority of our committee is very much against this. How do you feel about it? Are you with us on this? This will be terrible for our economy.
Well, I think it's important to ensure that credit availability is not significantly diminished.
But do you support this endgame business with Basel?
I said I do believe it's important to have a strong banking system with adequate
I really
and
wanted a
sensitive
yes or no.
capital.
The gentleman's time has expired. The gentleman from Texas, Mr. Sessions, is now recognized.
Mr. Chairman, thank you very much. Madam Secretary, welcome back. You're here today to discuss this annual report of 2023 from FSOC. And I want to refer to, if you have someone there giving you notes, page 10 of the report. But I'd like to start with, on February 16th, 2022, then the chairman of the Budget Committee, John Yarmouth, said in a well-understood statement, quote, "Congress need not worry about rising borrowing costs because we can print all the money we need," end of quote. The national debt at that time was $30 trillion. It is now $34 trillion, and the national debt will triple, just the projection, from $475 billion in 2022 to $1.4 trillion in 2032. At what point does this become a problem? And I say this because your own report says on page 10, higher interest rates and slowing economic growth, they correspond to each other, have increased non-financial corporate credit risk. If credit quality significantly worsens, a potential wave of debt defaults could lead us to large redemptions at investment funds with significant liquidity mismatches and in turn disrupt bond market functions. Moreover, such defaults may have a cascading effect across broader financial markets. Madam Secretary, tell me about what Chairman John Yarmouth, a Democrat from Kentucky, said, and tell me your viewpoint.
Well, let me make sure. Your question was about the federal debt, was it not?
Well, of course it is. That's what John Yarmouth was talking about, chairman of the Budget Committee.
Well, I think it's critically important that the U.S. Be on a fiscally sustainable path. And President Biden has put forward a series of budget proposals, most
Spending
recently,
proposals.
no, and also tax proposals and investment proposals that would, I believe, guarantee that we are on a fiscally sustainable path.
Does that mean ever attempting to balance any one particular year over the next 50 years?
Well, I don't think the budget needs to be balanced to be
This
on a
is what I wanted to
fiscally.
get at. So your tendency is to say, as Mr. Yarmouth did, Congress need not worry about rising borrowing costs. As you know, Treasury and the Fed are going to have to go to the marketplace and pay an extra large amount of money because of the risk that our debt now poses to the United States. And so they are paying record amounts for Treasury, which takes money that is in banks, local banks, out of local banks that provide small business loans, housing loans, that provide agricultural loans, that do all these things. It's shifting the marketplace literally $10 trillion from where it had been in stability to now to the Fed.
I believe that.
And we're paying for that.
I agree with you that we need to be on a fiscally sustainable path. And it's critical to reduce deficits in order to ensure that that's the case. And that is why President Biden's budget for 2024 proposed an additional $2.5 trillion of deficit reduction, coupled with investments in our economy that are critical to ensure that we grow and collect tax revenues that are.
Thank you, Madam Secretary. I would tell you that putting 10 million new illegal people in this country and living in Central Texas, seeing the federal government let all these people in, give them free ticket rides, cell phones, go to the city of their choice, live in housing to knock children out of their own school, protect them at Chicago International Airport, doing all these things is not wise management of our resources. Mr. Chairman, and Madam Chairman, I want to thank you for being here. Mr. Chairman, I yield back my time.
I thank the gentleman, and the gentlewoman now from New York, Ms. Velasquez, is recognized.
Thank you, Mr. Chairman. Ms. Secretary Yellen, welcome to the committee, and thank you for being here. I just want to say that I have great respect for my friend and colleague, Mr. Scott, but he does not speak for all members on this side of the aisle on the Basel III proposal. I, for one, support stronger capital requirements at our largest institution, and I want the record to reflect that. Ms. Yellen, the FSOC's annual report identifies property insurance, which is becoming prohibitively expensive or inaccessible for homeowners and developers, as an increasing risk to financial stability. This is becoming a more pervasive issue in my community, particularly when it comes to affordable housing. How is FIO working with the NAIC insurance carriers and state regulators to analyze this increasingly important issue?
Thank you for that question. We're very focused on rising insurance costs in particular areas of the country and the risks that it poses to homeowners, to banks, to financial stability. FIO has been working to improve our understanding of the ways in which climate change is impacting the availability and cost of insurance coverage. And in early January, OMB approved a data collection effort by FIO that would be at the zip code level to collect granular data to evaluate what's happening to insurance premiums and availability across the country. FIO looks to work with the NAC that's engaging in a similar effort to reduce the burden associated with this data collection, and that collaboration is ongoing.
And how is FIO working to ensure that it is not duplicating efforts already conducted by the NAIC or state regulators?
So there is a collaboration. The focuses and need for data is slightly different for NAC and FIO, but I think there's a good chance that they will be able to collaborate and go out with a single collection in order to collaborate and reduce burdens on insurance companies.
And has the council or FIO had any conversations with HUD on how these insurance premiums are impacting the operation of its affordable housing programs?
I believe that FIO and the council have had discussions. I know they have had discussions with other agencies. I'm not positive. I assume HUD would be in them, but I'd have to verify that.
Well, I will encourage your department to really talk to HUD, because we cannot address the affordability crisis that we have in housing in this nation without tackling the issue of the cost of insurance in our country.
Absolutely.
Last February, the Treasury Department published a white paper that identifies several challenges in the financial services sector's growing reliance on third-party cloud service providers. In response, an executive steering committee was launched by the FSOC. How has the executive steering committee worked with the big three service providers and the member agencies to reduce identified challenges?
So the executive steering group has been very active on this issue. They have formed, I believe, 9 different public-private work streams. Each one is looking at a specific gap that was identified in the report that was issued last February, and they're trying to understand also what authorities the existing regulatory agencies have, how they have been using them, and they will release recommendations later this year.
Thank you.
The gentlelady's time has expired. The gentleman from Missouri, Mr. Luke DeMeyer, who is also the chairman of the Subcommittee on National Security, is now recognized.
Thank you, Mr. Chairman. Welcome, Secretary Yellen. Good to see you today. As Vice Chairman of the Small Business Committee, it's disappointing that you still, almost 3 years from your statutory requirement to show up in the SBA hearing and get a report on PPP, have not done that. It's kind of amazing. You and your administration continue to pick and choose which laws you want to obey, which ones you want to ignore. So very disappointed. First question, though, deals with the World Bank. I had a conversation last week with the president of the World Bank, and he was talking about the need to increase capital. Unfortunately, that same board continues to give China preferential treatment and allows the world's second largest economy to be considered a developing nation. My question to you is, will you commit to making a capital increase conditional on graduating China for World Bank assistance and not allowing Beijing's voting power increasing their voting power at the institution?
So let me first say, we're not looking for a capital increase at this time for the World Bank. We do believe—
I'm not saying you did. I'm saying that the president of the World Bank— if that gentleman with the camera would get out of the way, please. Thank you. If, you know, they're looking to do that. So my comment is, let's don't do that unless you can get China, who wants to also increase their share, in a corner and not allow them to continue to be a country that gets assistance from the World Bank when they've got the second largest economy in the world, and then allow them to increase their voting.
Well, let me say we are strongly opposed to World Bank lending to China. We've pushed the World Bank and other MDBs to reduce and eliminate their lending volume to China.
Okay, well, my comment is we got to work harder. We got to make sure they don't have access to that bank. It's very important. You made a comment a minute ago that I really appreciate from the standpoint of the concern I have with AI. It is a wonderful technology. Hopefully it can do wonderful things, but it can also be used for some bad stuff. As we saw with Silicon Valley, social media and the 24-hour news cycle, suddenly within 10 hours, had $42 billion run out of the bank as a result of a tweet and social media following that around. AI could do the very same thing, and I'm concerned about that and have got some bills to address that. Haven't got a hearing on them yet, but hopefully that will happen soon. Along the lines, though, you talked about FSOC's role in these three banks and how you were able to help resolve the situation. My question to you is, what has FSOC done to fix the situation with these banks that are upside down with their interest rate? Their business models are off. They should be regulated differently. They should be forced to change how they're operating. Are you doing that?
Well, the responsibility for supervision of these banks and regulation rests with the banking agencies.
I agree with that, Madam Secretary. The problem is you, as the chairman, are overseeing the comptroller, also have the ability to go in and change these business models. Are you doing that with the national banks that you oversee?
Well, the OCC is an independent agency within Treasury. The FSOC is trying to understand and discusses the extent to which—
Madam Secretary, FSOC has got a tremendous amount of control over this. They can dictate how these things are done, how regulatory attitudes are toward situations. My question is, are you taking an active role in trying to get the banking models that are upside down and beyond the norm, are you getting them back in order?
I would say that this is a responsibility, the supervision of interest rate risk and liquidity risk is a responsibility of the banking agencies.
Well, I agree, but you oversee the banking agencies, so I'm hoping that you have some directions to those agencies to allow them.
We do not oversee the agencies. We identify risks and sometimes make recommendations to agencies about actions that they should take.
Well,
and they do have frameworks for managing liquidity, capital, and interest rate risk.
I got one more question to ask you here very quickly. Last week, Chairman McHenry, Mr. Jordan, Mr. Arzinga, and I sent a letter to FinCEN Director Gackey highlighting how FinCEN, an agency created to promote our national security, was using its authorities to target law-abiding citizens with countervailing political views. These allegations are evidences of Obama administration's Operation Choke Point, where I spent years investigating as the chair of an institution subcommittee. I'm just very concerned about that. We're going to have Chairman Gackey, our Director Gackey, in our committee very soon, and we're going to ask her about her involvement with you and your response to that.
The gentleman's time has expired. The secretary is directed to respond to that question in writing, if she could.
Yes, I will.
Thank you. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Madam Secretary, thank you for being here today. I want to follow up on my friend and colleague's question, Mr. Scott, earlier. I think he started out in this direction and then was running out of time and went in another direction. In my community, Kansas City, Missouri, there is a great deal of concern, and I would imagine around the whole country, that pandemic is not taking all of the lives that it was taking a couple of years ago, but its impact is still here, particularly on the economic level. We are probably all over the country concerned, or should be, I think, of that TREP company's analysis of commercial real estate. And they issued a frightening report, frightening is my adjective, that there is about a $448 billion worth of loans that matured last year, 270 billion of which were from banks. And we're having people breaking leases. We have others trying to renegotiate leases. In my estimation, we've got a problem with our commercial real estate, and it could impact, and I think that's where Mr. Scott was going, it could impact other components of the economy. Do you have a concern about where commercial real estate is and may continue to go?
Yes, I do have a concern about commercial real estate. We discuss it in the FSOC annual report, and FSOC has been quite focused on it. The banking supervisors have also been focused on commercial real estate and are working closely with the banks they supervise to discuss ways to manage and work with borrowers who have problems. They're, in some cases, working to make sure that loan loss reserves are built up to cover losses, that dividend policies are appropriate, that liquidity is adequate. So the higher interest rate environment, and in some cases, particularly the case of office building, shifts in work patterns due to the pandemic, coupled with many commercial real estate loans coming due and needing to be refinanced in a context where vacancy rates in some cities are quite high, is going to put a lot of stress on the owners of these properties. And so the banking agencies are very focused in helping the banks manage through these situations.
So you're concerned but not distressed. Is that?
Yes, I mean, I'm concerned. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
Thank you. Madam Secretary, are you familiar with Larry Kudlow, the former director of the National Economic Council?
Sure.
3 days ago, he said that, well, he conceded that his prediction of a recession was wrong and admitted that the U.S. economy is doing much better than expected under President Joe Biden. And he said that on Fox News. He offered a mea culpa because he had, if you look at some of his comments previous to that, everything was horrible. Do you agree with Mr. Kudlow that the U.S. economy is headed in the right direction?
I absolutely believe it's headed in the right direction. Our growth is extremely strong. The labor market is at least as strong as it was prior to the pandemic. We've got, it's been 50 years since we've had a string of unemployment rates this long under 4%. And job creation remains utterly robust. More people are participating in the labor market.
The gentleman's time has expired. The gentleman's time has expired. The gentleman from Michigan, Mr. Heisinger, who's the chair of the Oversight and Investigation Subcommittee, is now recognized.
Thank you, Mr. Chair, and I'll just note to my friend from Missouri, when the government's throwing that much money into the economy, yes, it has been propped up. I will also note it's so strong that the Federal Reserve cannot lower interest rates with unexpected job growth in those areas. So we're seeing inflation continue. Madam Chair, I want to very briefly touch on this. You clearly are not, I think I've wrote down a quote of yours, you're not going to take a position on the details of the rule. I'm talking about Basel III. Mr. Lucas responded, so any concerns don't rise to the level of feedback. Mr. Scott brought it up. A number of us have brought it up, both sides of the aisle. So who are you giving your thoughts to on the Basel III? Because clearly, I mean, with your background as as Federal Reserve, FSOC, Treasury, you clearly must have thoughts about Basel III. You're not willing to share them with us, but who are you sharing those thoughts with?
Well, I meet on a regular basis with all of the heads of supervisory agencies, including OCC, FDIC.
Okay, and the president, I assume, too? You're sharing that with the president? Your thoughts?
I haven't had a meeting with the president on this specific topic.
Okay, so then I'm left to assume that we are just then to be left in the dark till things get sorted out, correct?
Well, there's they've put out a notice of proposed rulemaking.
I know that, but you've had a number of
many.
people on both sides of the aisle asking your opinion, your learned, educated, experienced opinion about it, and you've refused to offer any of those insights to us. So I can't come to any conclusion other than you're sharing those insights with others, but you're not willing to share them with Congress, which is your choice. I think it's a bad choice, but that's your choice. I want to very quickly ask you down a path, and I'm trying to be equal opportunity questioner on this because I just asked Marcia Fudge this not that long ago. With the disaster at the FDIC under Marty Gruenberg's leadership and the culture, I'm sure you saw the article that all of us saw in November regarding the unacceptable behaviors that have been happening there. I'm concerned how it might impact their mission, and most importantly, how it would potentially spill over into the safety and soundness of our financial system. Following those revelations at the FDIC, did you take any steps at Treasury to make sure that Treasury isn't suffering from some of those same culture problems?
I mean, we regularly, we have a rigorous process for reporting and investigation of
Nothing new necessarily. And I'm not trying to be accusatory. I'm not saying that there is a culture problem under your leadership. I'm just curious if that prompted you to respond, and since obviously FDIC is part of FSOC as well, I mean, there's multiple times that you would have interacted.
I'm not aware of any such allegations at Treasury.
Okay, yeah, I'm not either. That's not what I'm saying. I just wanted to be clear. I'm asking everybody whether they have, when they saw the culture problems at FDIC, did that prompt anybody to change behavior or double down on making sure that whistleblowers are protected and those kinds of things?
We certainly believe in whistleblower protections and having in place systems that guard against the kind of thing that's alleged.
All right, I'll accept the answer. So I've got a minute and a half here. I want to shift topics to the CFRAC. Committee was established almost a year and a half ago. That's climate-related financial risk committee under FSOC. It looks like, according to the website, they've met twice, March 7 of 2023 and July 18. Your report devotes a lot of time to the potential impacts of climate change. In fact, you say that's one of the things the council is focused on member agencies, enhancing assessment efforts and increasing coordination around climate-related financial stability risks. That's in your written testimony. Has there been a problem? Has there been a lack of cooperation or coordination?
No, I think CFRAC is...
So then why are you having to enhance those assessment efforts?
Well, all of the agencies are increasingly focused on understanding the risks relating to climate change.
Okay.
And it's appropriate for them to work together to exchange information.
In my closing seconds here, are there any CFRAC meetings that have not been listed on the website?
Not to the best of my knowledge.
Okay, could you check on that and please get back to me?
Certainly.
And then I guess I'll finish with this. I'm sure you're aware the SEC has been working on their climate rule for 2 years. Do they consult, or do they just jam the rest of FSOC like they've been jamming those who they are trying to regulate?
The gentleman's time has expired.
It's the SEC's rule. I'm supportive of their requiring disclosure on that.
Any additional comments can be submitted for the record.
Thank you, Mr. Chairman.
Thank you. The gentlewoman from Ohio, Ms. Beatty, is now recognized.
Thank you, Mr. Chairman and Ranking Member. Secretary Yellen, thank you so much for being here today, testifying. And also, I want to take this moment to thank you for clearly outlining for us risk factors, but then identifying the 5 areas that you're working on with the risk factors, and for being very transparent about that. And also for the work that you do to keep our financial system safe and secure. I'd like to start with climate-related financial risk. The FSOC report identifies climate change as an emerging and rising threat to the United States financial stability. I too am concerned about this threat, especially considering the fact that low-income and minority households are more likely to face greater climate risk. Can you explain why these communities are at greater risk and how failing to address climate risk can exacerbate certain disparities that are already at risk, such as like housing values and the cost associated with home ownership in some communities?
Well, I believe there's a large body of research that shows that low-income communities are more exposed to some of the physical impacts of climate change, and that they may be less able to afford protections, whether it's for their home or insurance that's necessary to guard against it. And so it is a severe risk to low-income communities.
Thank you. Let me turn now to FSOC's guidance on the designation of non-banks as systemically important. First of all, let me thank you for your leadership in issuing this guidance. As we see increasingly large roles that non-banks are playing in the financial system, it is clear that any strategy to protect financial stability must also cover non-banks. Nevertheless, there has been some concerns about due process for non-banks that are designated as systemically important. FSOC's guidance emphasizes that non-bank designation process will entail engagement with both the company and its current financial regulator, if it has one. Can you describe what other due process protections exist for the company? For example, the ability to request a hearing, meetings with FSOC staff, or the need for a 2/3 vote for destination and how annual FSOC's reevaluation.
Well, I think you just listed the protections. The company would be provided with a great deal of information from FSOC if it completed stage 1 and entered stage 2. It would have opportunity to provide any information that it thought was eligible, the right to a hearing, and as you said, designation requires a 2/3 vote, including the vote of the chairperson.
And lastly, when I was the chair of DE&I and you would come before the committee, I think it's important again for me to thank you. You always had some of the highest numbers, or you admitted what you were doing and working on it. I think I should be concerned now in light of all that's happening across this country, including in financial institutions. I'm concerned about the effect that DEI rollbacks at financial institutions will have on our financial stability and on access to financial services in low-income or marginalized communities. And so I don't know if you have any comments, or are you concerned when we are still struggling in America to make it look like America?
Certainly, let me say the Biden administration at Treasury and other agencies I'm aware of, we have a robust and committed agenda to promote diversity in all of the work we do, not only in terms of our hiring, but in terms of all of the programs. For example, at Treasury, we have undertaken research that you're probably well aware of that shows that low-income individuals, African Americans, are disadvantaged by the way the Earned Income Tax Credit has been. So we are trying
The gentlelady's time has
root
expired.
out
Thank you, Mr.
The gentlelady's time has
Thank
expired.
you,
The-
Secretary Yellen.
The gentlewoman from Missouri, Ms. Wagner, is also the chair of the Subcommittee on Capital Markets, is now recognized.
I thank you, Mr. Chairman. Secretary Yellen, as Treasury Secretary, you championed requirements that any deposit flows into Americans' bank accounts totaling as little as $600 are to be reported to the IRS. Increasingly, we are hearing the federal government is suggesting banks search private financial transactions using highly partisan political terms, or check to see if customers made purchases that could be associated with legal sales of like firearms or even religious texts. My question is this: has Treasury, including FinCEN or federal banking agencies like the Fed, FDIC, OCC, instructed financial institutions to search Americans' legal transactions in attempts to surveil their purchases?
Well, we received a letter from you, I believe, on this topic, and we intend to investigate fully and to respond.
Have you instructed banks and financial institutions to provide this information?
Well, FinCEN's job is to work with financial institutions to make sure.
Are they instructing, ma'am, financial institutions to search Americans' legal transactions in attempts to surveil their purchases?
I promise a thorough look into everything.
Well, this is
that's
really
occurred.
concerning, and I would hope that you get to it just as quickly as possible, Madam Secretary. Secretary Yellen, I'm going to give this a shot too, since we all have, on both sides of the aisle. The Financial Stability Oversight Council, of which you chair, Madam Secretary, you chair FSOC.
I'm aware of that.
In 2023, FSOC put out their annual report plainly stating that, and I quote, "The U.S. banking system remains resilient overall." And, I quote, "U.S. banks continue to have sound levels of regulatory capital." Do you still stand by these statements, ma'am?
As an overall statement, I do.
Then what is the need for the proposed massive increases in regulatory capital requirements from the Fed, FDIC, and OCC?
They have proposed regulations to enhance the safety and soundness of some.
But you just said that the safety and soundness is there. It's resilient. They are well capitalized. It's clear in your, as a chair, your report.
Well, there are risks that that their guidance suggests could be handled better than
All
it
right,
has.
let me move on. Secretary Yellen, in a 2019 letter to Secretary Mnuchin and in 2021 testimony to the Senate Banking Committee, you said that activities-based regulation is the appropriate approach for asset management. Given the FSOC's recent guidance regarding the designation of non-bank financial institutions as systemically important, do you still stand by those public statements?
Well, I'm not sure that I said such a sweeping statement as you read. I don't know.
I have it right here. It's a letter.
I don't know if that's.
I'd like it into the record, please. This is your letter with those words, ma'am. So I would tell you to go back to your 2019 letter and then again to your Senate banking testimony in 2021.
2019, did you say?
In 2019, a letter to Secretary Mnuchin, and in 2021, your testimony to Senate Banking Committee. You said activities-based regulation is the appropriate approach for asset management. I want to know why we're finding, DEFSOC is saying that designations of non-bank financial institutions are systemically important. Clearly, others don't. Why do you believe FSOC did wrong that led to the courts vacating the MetLife designation in 2016, ma'am?
Look, so there is no preferred approach to how to handle a financial stability risk that's been identified. In some cases, and perhaps this is what I was referring to, if that's an accurate quote,
It is.
We are, for example, concerned about risks associated with money market funds.
Are you doing
We
a
have
cost-benefit
been
analysis?
concerned-
Anything?
Excuse me, we have been concerned about the pressures on open-end bond funds that can be forced to sell less liquid assets. These are industry-wide practices that are probably
The court has already
best
vacated you once,
addressed
ma'am.
with activity-based approach.
Mr. Chairman, I yield
Secretary
back.
may-
Yes,
The
he's-
Secretary may respond in writing the remainder of the answer. The gentlelady's time has expired. The gentleman from Massachusetts, Mr. Lynch, is now recognized.
Thank you, Mr. Chairman. Madam Secretary, would you like additional time to express your thoughts there? You were sort of cut off. Rather than adding them in writing, would you like some time to respond?
Yes, if I could just.
Or we could move on, whatever your choice.
Thank you. If I could finish the thought.
Yeah, that'd be great. Yeah.
Sometimes activity-based regulation is the appropriate approach when there's an industry-wide practice of concern, as, for example, has been the situation with money market funds or with open-end bond funds. However, sometimes the risks have to do with a particular institution. For example, the largest U.S. banking organizations are recognized that their failure could result in a threat to financial stability. The same could be true of a non-bank institution, and in that case, designation is appropriate, but it depends what's the appropriate form of response by FSOC depends entirely on the specifics of a situation and the threat that's involved.
And I thank the gentleman for his time. I couldn't
Reclaiming my
disagree more.
time, reclaiming my time. Well, that makes perfect sense, Madam Secretary. Recently, FSOC identified the use of artificial intelligence in financial services as an emerging vulnerability in the U.S. financial system. And not very long after that, Chairman McHenry and Ranking Members Waters created a bipartisan working group on artificial intelligence, and I have the good fortune of being the top Democrat on that working group. I have some concerns. I think there are some opportunities, I think, to use artificial intelligence in a thoughtful way. I think about the work that FinCEN does and trying to analyze suspicious activity reports, suspicious transaction reports, and CTRs, and how they might analyze those. But I think there's also a risk on the explainability end of some of these algorithms that are being used, and also the fact that many smaller firms are acquiring, rather than developing their own data sets and developing their own artificial intelligence, they're just simply buying them. And I'm not quite sure that that they have the expertise or the personnel to make sure that technology is used in a compliant way with existing financial regulation and laws. Do you have a sense of whether we have the capacity in the industry to onboard much of this artificial intelligence that is being that vendors are offering to financial firms?
Well, we are concerned. In this year, FSOC identified the use of AI in the financial sector as a potential financial stability risk. And at the moment, we're trying to understand what the risks are. Some of them are related to, as you said, explainability when models are used and generate outputs. I believe the CFPB has been clear that financial institutions, when they take credit actions, have to explain to the customer what the reason is, and not to be able to say, well, an AI system generated this result. But there are a whole variety of risks to customers, to cyber, and we're trying to build our expertise and work with the financial sector to address these risks.
Is it accepted that, at least from Treasury's position, do we accept the fact that when a financial firm acquires AI, that AI company, that vendor is now a covered entity under, financial services laws? Is that accepted, or is that still in dispute?
I'm not sure. I need to get back to you on that.
Okay.
But certainly when it comes to third-party providers, the banking regulators, for example, do have authority to make sure that
The gentleman's time has expired.
standards are being met.
The gentleman's time has expired.
Thank you, Madam Secretary.
I now recognize myself for 5 minutes. And Madam Secretary, you tout a historic recovery, a healthy labor market, and, quote, economic strength. And Larry Kudlow's name was invoked earlier in this hearing, the former Trump White House economic advisor. I know Larry Kudlow, and yes, he acknowledged that we're not in a recession right now. And I wouldn't presume to speak for Larry Kudlow, but I do think he would agree with me that asking Americans to feel good about Bidenomics is like asking them to smile during a root canal. The discomfort is just too hard to ignore. Americans continue to suffer from the effects of 40-year high inflation experienced throughout the Biden term so far, including lingering high prices. And the administration may wish to tout inflation numbers coming down. But Madam Secretary, you're an economist, and as you know, inflation, which is the rate of increase in prices, should not be confused with the overall level of prices. And prices have continued to rise even as the rate of inflation has fallen since the Fed began an aggressive program of monetary tightening and since House Republicans put a stop to Washington's spending spree. So as a result today, even with the decline in the rate of price increases, a family of four is paying $15,000 more per year just to purchase the same goods and services compared to the day President Biden took office. Yet the administration's plan to fix inflation caused by too much spending is even more spending. That's why the Inflation Reduction Act is perhaps the most misnamed legislation in American history. But this is a supply-demand mismatch. Too much spending created excess demand. Climate obsession constrained the supply of energy. But now, the administration and the Fed is proposing to constrain the supply of credit, which will exacerbate inflation through this Basel III endgame, precisely when corporate and commercial real estate borrowers will need to refinance at higher rates. So, Secretary Yellen, I want to ask you about Basel III. The heterogeneity and business model diversity within the banking sector distributes and diffuses risk across the system, and I believe contributes to system-wide financial stability. The Basel III endgame proposal would de facto repeal regulatory tailoring, subjecting Category 3 and 4 regional banks to one-size-fits-all standards that currently apply to GSIBs, eliminate the use of internal risk models, and transition the industry and regulators toward a standardized framework, reducing business model diversity, and push financial intermediation and lending outside of the bank regulatory perimeter. The banking industry will get smaller and more concentrated as a result. How does any of this reduce systemic risk?
Well, having strong capital and liquidity and resolution standards, I believe, does diminish systemic risk. And I think we have seen a clear example of this in the ability of the banking system to weather the pandemic.
Yes, ma'am. And reclaiming my time, just real quick, reclaiming my time, you have said many times that our banking system is currently well capitalized. Do you agree that a less diverse banking system, a barbell banking system, banks under 100 billion not directly affected by this proposal, and Wall Street too big to fail banks, but no regional banks because of the forced consolidation this would provide, and less diverse business models that this proposal will produce, do you believe that that strengthens financial stability or undermines stability?
I think we benefit from having a diverse banking system with institutions that meet different needs of different firms and
I agree.
different households.
And Secretary,
banking agencies have received extensive comment
Yes.
on all of these issues.
I know, and just reclaiming my time, because I only have a minute left, I agree with you that diversity and heterogeneity in the banking system and diverse business models actually diffuses risk, and FSOC should consider that as they consider Basel III Endgame. So to my final question, continuing with this topic of consolidation, which I believe Basel III would accelerate, the OCC's recent proposal on mergers and acquisitions would ban mergers for a nationally chartered bank, even if it's a transaction for a smaller CDFI or adding essential technology expertise. Even the smallest banks would face new scrutiny and prolonged delays of mergers that could threaten their viability. The OCC's proposal will increase the likelihood of costly and disorderly bank failures and decrease competition for GSIBs. Secretary Yellen, won't this proposal increase systemic risk and reduce banking services?
I'm sorry, I think this is a question for the acting controller of the currency rather than...
Well, my time has expired, but I think it's an FSOC issue, is the fact that you would not have orderly consolidation and result in bank failures. That is a systemic risk issue for you, Madam Secretary. With that, my time has expired, and the gentleman from California, Mr. Vargas, is now recognized.
Thank you very much, Mr. Chairman. Thank you very much, Madam Secretary, for being here. Appreciate it very much. I'm going to try a couple questions here. First question, trivia question. When was the last Republican president that ran a budget surplus?
I can't think of one, but...
Think hard. Because I don't remember, but every time I'm here...
I certainly remember that Bill Clinton did.
Oh, Bill Clinton, was he a Republican?
I don't believe so.
I don't believe so either. Yeah, it's interesting. Every time you get up here, you hear these guys on the other side start touting, you know, their fiscal responsibility, and yet every time they have a president, they either jack up the deficit, ruin the surplus, or destroy the economy. And then we come in and we fix it, and then they're upset. Once again, they become fiscal hawks. Now, I do have something I have to get off my chest about you, and that is, I think you're probably the smartest person that comes and testifies before us, and I think most people would agree with that. And yet, every time you used to come and they used to beat you up on inflation, you never put it in the context of what was happening in Europe and the rest of the world. You would simply try to explain inflation within our own country, and it used to drive me nuts because we were doing better than the rest of the world.
We are.
We are, and you never said that. And I was too far down the totem pole here to ever be able to get to ask you that question.
Well, if you look at the United States vis-a-vis other advanced countries, we have by far the strongest growth. Inflation has fallen more in the United States than in any of these other advanced countries, with the exception of Japan, that has a different set of issues. And importantly, real wages, inflation-adjusted wages. I believe we're the only country that, since the pandemic, has seen those increase. And I think, according to our calculations, if you compare today with 2019, before the pandemic, that the typical American household has enjoyed wage increases large enough that the median worker is able to buy the same basket of goods as in 2019, with $1,400 left over to spend or save. So we've gotten ahead in the United States. It's been an equitable recovery, includes and even the strongest gains for low-income people.
So I agree with all that, and I wish you would have said it before, because it always used to annoy the hell out of me, because you would lead with your chin. I think you're the smartest person here, and maybe the good thing is that you're not political, and that's why I think you'd lead right into their questions, which was political questions. They were really sophist, if you study the Bible. They were really asking you questions to try to do a gotcha. And it always used to annoy the hell out of me, and you never explained it this way. I'm glad you did today. I do want to talk about climate. That's the issue that has also driven me mad these last
2 decades. I've been preaching this for a long time, saying we have to do something about it. I did work in the insurance industry for a while, and whenever you had a big event, we called it a CAT, or catastrophe. And you numbered them by a year catastrophe, a 5-year, 15-year, 20, 25-year, 50-year, 100-year. We just had what they would call a 1,000-year event in San Diego. And now we're having what we call a 100-year event again in San Diego. They're no longer, cats of 100 years. They're happening all the time, and it's the weather. This is a real risk.
Absolutely. It's clear that's exactly what we're seeing. And vulnerable parts of the country, whether it's California or Florida, in some cases in New York, Louisiana, we're getting priced out of insurance. Either the rates are becoming unaffordable, or insurance companies don't want to bear the risk, can't reinsure adequately, and are pulling out. And
there's a line in insurance, Madam Secretary, that you should know. There's never a bad risk, only a bad price. And when they take a look at this and they see what it's going to cost them, these actuaries, they're soulless people. They sit in this room and they find out what it's going to cost them, and they're not in the business of losing money. And they look at Florida, they look at these places, and say, we're not going to lose money. That's why they don't want to insure there.
Absolutely.
They're soulless people. I'm not saying they're bad people, just don't have a soul.
They don't want to
Again,
lose their
my
insurance.
time is up. I thank you very much.
All right. There's bipartisan laughter at actuary humor. We'll now go to the chair of the Small Business Committee, Mr. Williams of Texas.
Thank you very much. Well, I'm a car dealer, not an insurance guy, so let me put that out there. The crisis at our southern border has spiraled out of control, and the Biden administration has done little to nothing to secure the border and keep Americans safe. This increase in illegal immigration raises concerns on how the increase in migrants coming down across the border is impacting our financial network and opening the door to financial crimes. Money laundering, drug and human trafficking, and financial fraud will continue to plague our communities if nothing is done. I recently introduced the Evaluating the Financial Impacts of Illegal Immigration Act, which requires FSOC to include illegal immigration risk, an emerging threat to our financial system, in their annual report and provide recommendations to mitigate these risks. Our states and cities are not equipped to deal with the influx of millions of migrants who put a significant strain on our public resources. We must hold government agencies accountable to report on how illegal immigration impacts Main Street and the larger financial system. So, Secretary Yellen, this will be easy, just yes or no. Do you agree that illegal immigration is a potential threat to our financial system? Yes or no?
Well, I can't answer it just yes or no. You've pointed out some risks that are associated with immigration, and whether or not that's a threat to our financial stability is a complicated determination.
So you would say yes?
I would not say yes.
You'd say no?
I say it requires further
All right.
analysis.
So as I previously mentioned, we've seen the strain that illegal immigration has and will continue to have on our public resources. Therefore, I think it's necessary to see how far these impacts reach. And I request that you use the power as the chair of the Financial Stability Oversight Council to investigate this emerging risk. Okay? So over the last year, our nation's federal banking agencies have been bombarding our financial system with excessive regulations and dangerous proposals like Basel III Endgame, which will dramatically affect the banking community and have other broad impacts on Americans' ability to access reliable credit. Now, these increases in costs will make it harder for Americans to obtain a loan, whether they want to start their own business, expand current business operations, or buy their own home. Small businesses and everyday Americans rely heavily on loans and credit lines from banks of all sizes to access the capital they need to do so. Multiple regulators, including Chairman Powell, have come before this committee and testified that our banking system is already well capitalized and resilient, and FSOC's 2023 annual report stated that banks continue to have sound levels of regulatory capital. So, Madam Secretary, if FSOC and federal banking regulators have repeatedly identified the U.S. banking system as capitalized and resilient, then what is the need for the proposed massive increases in regulatory capital called for in Basel III Endgame proposal? And also, how can we ensure proposals are good public policy when they lack a rigorous cost and benefit analysis?
Well, I believe that the banking agencies, in putting out their rule, have pretty clearly articulated what their concerns are with the way in which operations risk and market risk are handled, and some of the ways in which internal models are used to evaluate credit risk. And I know they've received many comments, and we'll take those seriously in coming up with a revised final rule proposal.
In the time that I have remaining, in 2023, FSOC listed climate change as vulnerability to our financial system. Under the Biden administration, financial regulators are calling for climate policies to be included in banking regulations, which extends the federal banking system beyond its intended purpose and threatens the agency's long-term independence. Now, this sets a dangerous precedent that could lead to overall polarization of our financial system. So quickly, Secretary Yellen, is FSOC exploring nature-related financial risk, and will they urge federal banking agencies to issue guidance to financial institutions on how to manage purported nature-related financial risks?
The banking agencies are evaluating what the impact of climate change is on the institutions they regulate and working with them to make sure that they are adequately evaluating the risks that climate change pose. And those are important supervisory activities that bear on safety and soundness.
Okay. Mr. Chair, I yield my time.
Gentleman yields back. Gentleman from Illinois, Mr. Foster, the ranking member of the Financial Institutions Subcommittee, is recognized for 5 minutes.
Secretary Yellen, as I discussed in my opening remarks, I am happy to see FSOC identify artificial intelligence as an area of concern for the financial system. While there are clearly benefits of certain applications of AI in areas like customer service, credit underwriting, and certain forms of fraud detection, I am worried that we are heading for a disaster when it comes to generative AI and deepfakes. Just last week, a finance worker at a multinational firm was tricked into paying $25 million to scammers following a multi-person video conference call with whom they thought were their colleagues, but were in fact deepfake AI impersonations. Not only did the scammers simulate the voice and likeness of the chief financial officer, they simulated several of the employees' colleagues at the same time. Now, I believe that the clearest and cleanest solution to this issue would be to have a simple but reliable form of digital ID, built off in the United States, built off of TSA's Real ID system, and based on NIST technical standards that are already built into all modern cell phones. Then that U.S. citizens could then use this to prove they are who they say they are online and verify one's identity remotely. Several states are rolling out these mobile IDs for things like keeping children off porn websites. And several European and Asian nations have already taken steps to offer their citizens this form of digital ID backed up by a secure device and biometrics. The EU is moving rapidly towards a standard, and they are using it from the start to be useful to verifying financial transactions. So first question, are you aware of the steps that other nations are taking not only to offer digital ID, but to make it usable for verifying financial transactions? And do you believe it would be a useful component in preventing deepfake AI impersonations here in the United States?
I think you're making a very valuable suggestion. I know that FSOC is in Treasury, you're engaging on this issue with financial institutions. Our staff are planning to issue a report on AI-specific cybersecurity and fraud risks. I believe they plan to issue that by the end of March. I've not seen the work myself that they're doing on this report or what recommendations they'll come up with. I know they will be doing follow-up work with the financial sector, and I think you've made a very valuable
many
suggestion.
financial firms I talked to just told me that a reliable form of digital ID would really simplify all of the AML KYC process, make it faster, cheaper, more reliable when they had to confirm the identity of customers. And so you also mentioned the difficulty with having this spread out in many agencies. For example, the TSA and the DHS committee in Congress sort of are in charge of the of the mobile ID, the real ID system. On the other hand, it's FinCEN in Treasury that would supervise its use for financial transactions. The actual technical standards are done by NIST, which is the oversight of the Science Committee. So we have at least 3 congressional committees that are all siloing this whole thing. And so is there encouragement that you need to get FinCEN, NTSA, and NIST to all work together to deliver a product that can eliminate deepfake impersonations in financial transactions, at least?
My suggestion would be that my staff contact you and work with you on the specifics of this and give you some specific information on exactly what our thinking is on this. I'm not
And if you find any
enough to,
specific encouragement from Congress, I think there will be bipartisan support for that on all 3
of course, this is a significant risk, and it's
Okay, now in my 42 seconds here, last January, I introduced the Strengthening Cybersecurity for the Financial Sector Act that would give the NCUA and Federal Housing Finance Authority the authority to oversee third-party vendors that are employed by the entities under their purview. Other prudential regulators already have this authority. However, NCUA and FUFA's authority were allowed to expire, and this left a dangerous gap that leaves consumers and our system at financial risk. In fact, last November, a cybersecurity breach of third-party service providers disrupted the operations of 60 credit unions across 40 states. Can you explain why this authority is important and the kind of risk that this lack of authority presents the financial system?
Well, it's critical to oversee these providers, and FSOC has recommended that NCUA and FHFA be given these authorities. We appreciate your legislation and would be glad to work with you on it.
We'll now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Mr. Chairman. Ms. Secretary, thank you for being with us. Good to see you again. I want to start off by asking you about the non-voting state insurance commissioner seat on FSOC. While I support the long-standing idea of state-based insurance regulation, I recognize that the insurance industry is critical to the overall stability of our financial system. Nearly every aspect of our financial system is represented by its primary regulator on FSOC with a voting seat. But without a voting seat for state insurance commissioners, the council is missing the direct input from the primary regulators of the industry. My question is, do you agree that we should have state insurance regulators with a voting seat? And if not, why?
Well, I absolutely agree with you that the insurance sector is critical and needs to be represented. I would note that there is a voting member of the council who is an independent member with insurance expertise. That person is confirmed to that position. And in addition, there is a state insurance commissioner, a non-voting member, but someone who serves a 2-year term designated by NAIC. So there is a good deal of understanding of the insurance industry represented on FSOC, and I think that's totally appropriate.
Do you not feel that it would be better representing of the primary regulators of the insurance industry if the non-voting member from the State Insurance Commission was actually a voting member?
So I don't have a position on this. Congress set up FSOC in this manner, and what I can tell you is that all of the members, voting and non-voting, contribute importantly to the work of FSOC. I've really never seen an issue that I've dealt with where the voting status of a person who's part of FSOC would have made a critical difference.
So it would be fair to say that if Congress did seek to change this, you would not oppose?
Well, I would look at the specifics, but I would agree with that we do need to have insurance expertise, and happy to look at something specific that you're considering.
Okay, well, thank you. Earlier, you were asked about the Federal Insurance Office, FIO, plan to collect 6 years' worth of granular data on climate-related financial risk. FIO expects hundreds of property and casualty insurers across the country to assume the burden of compiling this data. You asserted that FIO looks to work with state insurance regulators as required in the Dodd-Frank Act, but FIO claims that the data they had initially requested was, quote, not available or could not be obtained in a timely manner from state regulators. Secretary Yellen, how did FIO define the timely manner for the purposes of collecting this data?
Well, my understanding is that the NAIC intends to conduct its own survey and recognizes the desirability of collecting this more granular data. And given that both FIO and NAIC want to collect this data, there clearly exist opportunities to collaborate. I believe they're certainly trying to do that.
Well, I guess I'm a little bit confused is they defined that they needed the data within 30 days of the request. Now you're talking a significant amount of data, but they were obscure as to what they needed the data for. And so why did FIO anticipate needing this data within 30 days? So you're asking these insurance questions that are very detailed and giving folks 30 days to respond, and it was kind of obscure in the question. I'm just wondering why such a short time frame?
Okay, I must admit I don't understand if that's the time frame or what the logic was, and maybe I can get back to you on that.
Just with the remaining time I've got, in your view, was FIO's limited effort of trying to obtain this data within the short time frame and then claiming that they weren't able to get it, is that actually consistent with the Dodd-Frank requirement to coordinate with state regulators, not just ask them, can you get this data, and they say, we really don't have time, and then say we couldn't get it? I mean, to me, it seems like working with them is coming up with a reasonable plan to get the information they need and be clear as to why.
I believe they intend to do so, and it's appropriate.
Thank you.
Gentleman from New Jersey, Mr. Gottheimer is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member Waters. Hello, Secretary. Thank you for being here. Secretary Yellen, are you aware that from 2014 to 2019, 200 American colleges and universities illegally withheld and failed to report information on $13 billion in undisclosed contributions from foreign and authoritarian regimes?
I don't believe I am. I'm sorry. What happened? The college, something about colleges?
Colleges received and didn't report funding from foreign and authoritarian regimes. I've sent you a letter, which I'll make sure you get a copy of, urging Treasury to coordinate with the Department of Justice and Department of Education to investigate these American colleges and determine whether any of the foreign and authoritarian regimes contributed to the funding of anti-Semitic protest groups on our college and university campuses. And so I'll also enter the letter into the record, if that's okay, Mr. Chairman?
Without objection.
And again, thank you for reading it, and if you can get back and determine whether there are financial connections between those foreign entities making large donations to our institutions of higher learning and the outside funding of anti-Semitic protests on campuses, I'd be grateful.
We'll respond to your letter, try to do it in a timely way.
Thank you. Madam Secretary, the last time you were in front of this committee in June, you agreed with me that the state and local tax deduction, or SALT, has had a disparate impact on different states, including New Jersey, where I'm from. You've also committed to finding a fair solution for the misguided limit that leaves double taxation on many of my constituents, especially middle-class, hardworking families. There may be a potential vote on SALT legislation as early as next week. The bill would double the SALT deduction for married couples in 2023 from $10,000 to $20,000. Do you believe, following on the question when I saw you last time, do you believe that this legislation will help ease the disparate impact of SALT on married couples in New Jersey?
You know, I agree that SALT has had a disproportionate impact on different states. There are also fiscal implications from the legislation that you discuss. I haven't had a chance to examine, and it's really up to the White House and the President to decide whether or not to be supportive of this.
My concern from a Treasury perspective is the IRS preparing for such a change should the bill be enacted, because they would have to move pretty quickly.
This would be for 2023?
Yes.
I'd have to
If
look
you
into
can get back to me
that.
on that, I'd be grateful. We know that Hamas relies on support from the Iranian regime, the leading state sponsor of terror. As Iran deepens its ties to China and Russia, we are reminded they cannot be trusted and must be held accountable. Iran has directly or through their terrorist proxies, including Hamas, Hezbollah, PIJ, killed hundreds of Americans, attacked our bases and our allies in the region. Treasury has implemented several rounds of sanctions on Hamas and Iran in the aftermath of October 7th. Madam Secretary, do you believe that the U.S. should impose sanctions on China because of its ties to Iran?
I'm sorry, on China because of its ties to Iran?
Yes.
Well, that's a question really for the State Department and the interagency, and I'm not aware that that's been considered. I don't have a position to offer you on that.
Okay, because concern that Treasury hasn't enforced Iran oil sanctions, especially sanctions targeting China and its dozens of teapot refineries that are responsible for practically 100% of Chinese oil imports from Iran.
Look, what I can tell you is that the Treasury Department and OFAC are doing everything that they possibly can to crack down on illegal Iranian shipments of oil. And we've recently had actions in that regard and believe seizures of illicit material as well.
Thank you. I know Treasury's OFAC publishes a list of individuals and companies owned, controlled by, or acting on behalf of individual groups and entities such as terrorists. Their assets are blocked, and U.S. persons are generally prohibited from dealing with them. In recent weeks, it's been reported widely that UNRWA employees have engaged in terror activities and materially supported Hamas in the massacre and in other depraved atrocities committed against Israel. Is Treasury considering terrorism designations for UNRWA employees that have been found to be material supporting Hamas or engaging in terror activities themselves?
We've engaged, as you mentioned, in numerous actions against Hamas and a wide range of supporters.
While the U.S. gives millions of dollars to UNRWA every year, the organization doesn't screen for known terrorists and terror affiliations the way U.S. agencies like USA would do. Do you believe at a minimum the UN agencies that receive U.S. aid should at least vet employees against U.S. terrorism lists?
I don't know. I don't know the details. I'm happy to look into that. That certainly seems reasonable.
Thank you, Madam Secretary. I'll follow up with your office. Thank you so much.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Chairman. Madam Secretary, thank you for being here today. And I just want to highlight a couple of the activities of FSOC. For the last 2 years, FSOC has made digital assets one of its top priorities. Do you believe that it is appropriate for FSOC to list digital assets among its top priorities, given the relative size of the market?
Well, the market is relatively small, and I believe the annual report states that. And the connections are not enormous to the banking system, although role involvement in digital assets did play some role in the banking problems we had last March, particularly with respect to Signature Bank and to Silvergate. So there are concerns along those lines.
Well,
but
in that
there
sense,
is the potential for example, stable coins that we've made recommendations to Congress require regulation.
They could. If the Secretary will suspend, if you could please exit the dais for members. Thank you. We can continue. Thank you.
Stable coin, there is no appropriate regulatory framework.
We've certainly been working on that. It'd be great to get it across the finish line.
Well, I appreciate that, and we've tried to work on a bipartisan basis with the committee to see legislation enacted.
And so the concern would be that there's some systemic risk to the market because of the introduction of digital assets. And you referenced Silvergate. They didn't pose a systemic risk to the market. In fact, they wound down in a very orderly fashion with no risk to the market. Not true of Silicon Valley Bank, but that was interest rate risk, not digital assets. Signature, on the other hand, there was an FSOC meeting on Saturday, and on Sunday, the assets of Signature Bank were seized. And former Congressman Barney Frank, whose portrait hangs right there, former chairman of this committee, said that it was because they were banking crypto, not because they were insolvent. So it kind of highlights, is there a coordinated effort because there's a disfavored industry like digital assets, or is there a coordinated effort because there is actually systemic risk?
Well, FSOC has recommended to Congress that stable coins require a regulatory framework. No stable coin at this point may yet have achieved the scale that would pose a systemic risk, but certainly that could happen if a stable coin were widely used for payments. And you have the classic run risk that's associated with that if the stablecoin proceeds are not invested in a secure and utterly safe
Well, this is the case.
And we've seen this happen with similar types of. It's essentially a banking type of product.
It's not fractional reserve banking, and those banks are regulated. Stablecoins certify that they have $1 of government-backed securities for $1 of tokens issued.
They don't always certify that.
No, the three that are regulated in the United States by the New York Department of Financial Services, or four actually, do certify that, and they are state regulated. The one that doesn't, that the Treasury Department and others seem unwilling to address by providing clarity in our market, don't certify that. Tether is a time bomb, and it is offshore, and it's the only thing functional, frankly. Everyone is moving offshore because we can't agree to regulate our own markets. And frankly, there are people that really would love to regulate the market. There just always seems to be an excuse not to. Kind of like, to change topics here briefly, the GSEs. So there was a report that was due to Congress on September 30th of 2021, so quite a while ago, that report was due, as to what is the plan to end the conservatorship, which has gone on longer than Britney Spears' conservatorship went on at this point. So it would be great to get the plan, if not whether we agree or not, but could you commit to give us the plan?
Well, that was a promise made by the previous administration.
It's a statutory requirement,
days.
Madam Secretary.
And we are committed to working with Congress to clarify what a reasonable strategy is for the GSEs.
Whatever the plan, it is already the law to give us the plan, and I yield back.
Gentleman's time has expired. We'll now go to Mr. Caston of Illinois for 5 minutes.
Thank you, Mr. McHenry. Pleasure to see you, Madam Secretary. I want to touch on a couple things, but the first, I don't know if you had a chance, and it doesn't matter if you read it or not, there was a CBO report that came out on January 18th about demographic trends in the United States. It's been rattling in my head for a while, and it was 2 weeks ago, but it said, among other things, that net immigration, which some of my colleagues have mentioned, is running twice as high as was expected, and that the population of folks immigrating to the United States are unsurprisingly, overwhelmingly of working age, 25 to 54. The sort of demographic trend that I think is the kind of thing that keeps Tucker Carlson awake at night, that our population is aging and our country is getting more diverse. But what I'm wondering if you could speak to is the conversation with Mr. Vargas, we talked about the fact that this economy is doing things that economies aren't normally supposed to do. GDP is rising, we keep creating jobs, unemployment rates keep falling. And how much of that is directly attributable to the fact that our workforce is growing so much faster than we anticipated?
Well, part of it is due to the fact that labor force participation has increased.
I don't mean just the participation rate, though, the actual number of workers.
Yeah, I mean, partly it is immigration, but it's also, we're seeing a big pickup in adult labor force participation in the aftermath of the pandemic. Perhaps some of that, some of it is the availability of jobs, which has been amazing, and some of it is the ability to work at least partially from home, maybe drawing people into the labor force who otherwise wouldn't do so. But that's one way in which we continue. Just the last 3 months, we have an average of 290,000 jobs a month being created, which is quite remarkable.
Yeah, I think about a comment that Jay Powell said, I think a year ago, that he said the growing workforce, not just workforce participation, the growing workforce was helping to rebalance the economy. I think his words was that it was tilted too much in the favor of workers. I know some workers who might disagree, but nonetheless, seems to be there. You had mentioned in your discussion with Mr. Vargas that where our growth on all these metrics, from GDP to job creation, recovery from COVID, is outpacing all of our other peers. Mentioned Japan being an exception that famously is not as open to immigration as some other countries.
That is true.
And maybe it's too soon to say this, but can you speak to what the United States has done that has led to our outperformance relative to other industrialized economies since COVID?
We have supported the economy in difficult times, and particularly the households and workers who were most affected through programs including the American Rescue Program that made sure we didn't have permanent scarring of individuals who lost their jobs and remained out of work and maybe discouraged and essentially scarred to the point where they can't participate in the workforce. We made sure people had a roof over their heads and food on the table, helped them take care of their children, provided emergency rental assistance, and then put in place a series of programs as the economy, as people got back to work, that are investing in people. The Bipartisan Infrastructure Program, the CHIPS and Science Act, and the IRA are stimulating tremendous amount of investment and creation of good jobs, especially in parts of the country that haven't seen opportunity for a long time.
I think we've got a lot on this side of the dais and in your office, a lot to be proud of what we did to go through. And maybe we can follow up offline. When so much of the growth in working age population is from the foreign-born population, and when so much of the conversation over here on the Hill is using immigration as a political football, I want to make sure we don't cut off our nose to spite our face and understand how that contributes.
I agree. I think it's been a plus.
I see I'm out of time. I had wanted to follow up with you on the FIO and climate risk, but I'll follow up with you offline on that one. Thank you. Yield back.
Thank you.
Gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman McHenry and Ranking Member Waters, for holding this hearing, and thank you, Secretary Yellen, for taking time to be with us today. Secretary Yellen, I've been following news of insurers pulling out of states like California. And as a former state official myself, I'm confident that the culprit is a terrible state-based regulatory environment. Given the focus of this administration and the Treasury Department on the solvency of the financial system and our financial institutions, what would be the impact of insurers underwriting the risk of their policies at levels that are lower than actuarially sound?
Well, they would tend to lose money over time and not commercially viable for them to do that.
Thank you.
Without some other government support.
I completely agree. And what would happen to the fiscal stability and solvency of insurers who were forced to issue policies at rates that do not reflect the risk they cover?
Well, they would be financially challenged in the event that a risk event materializes.
Thank you. I completely agree with that. Thinking back a couple of years ago, actually go back to the fall of 2021, as you'll remember, Some of us on this committee were concerned about the overly aggressive spending of the federal government. We were concerned about early signs and signals of inflation. And in a hearing at that point, I asked you about, did you have concerns about the national debt? And as I recall, and I'm paraphrasing your words, but you expressed the view that the interest payments as a percent of GDP were particularly low, and that maybe that was a more reasonable way to measure the federal debt. Shortly after that, I asked the Fed chairman whether he would commit to keep interest rates at near zero so as to make sure that the cost of financing the burgeoning federal debt remained low. He answered correctly that he would not, in my view, and he has not. The Fed has not kept rates low. And so we find ourselves, fast forward a couple of years, and we find the cost of financing the federal debt ballooning. The Congressional Budget Office has recently stated that the higher interest rates could lead to the government's net interest payments spiking to 6.7% of GDP and beyond. And of course, current estimates this year is that net interest may exceed $800 billion and just a stone's throw away from exceeding the cost of national defense. I wonder, in light of these changes, has your assessment of how we measure the capacity of this country to finance and to continue to incur additional debt, has that changed?
Well, I still believe that real net interest is an appropriate metric for judging the path to decide whether or not a fiscal path is sustainable. Real net interest in, I believe, the most recent Biden administration document, the mid-session review, I believe that it remained over the 10-year window, given the proposals in that budget, at around 1%, which is historically normal. But the budget included $2.5 trillion of deficit reduction that Congress hasn't acted on. So in order to, now that's a low level, and with higher interest rates, now, we've always projected that interest rates would rise from extremely low levels to more normal levels. But if the interest rate path moves up, that does imply, of course, higher real net interest.
Pardon me, in the interest of time, if we assume that rates remain at historic long-term norms, which would be at or above the current levels, is the current fiscal situation sustainable?
Well, we've not yet issued. It depends on the actions that we take. And
so new debt would be difficult to support at these interest rates.
We're preparing a budget for the next fiscal year, and will contain proposals to make sure we are in a fiscally sustainable path.
Well, I'm deeply concerned about it. I fear we are nearing the point of a tipping point where this country cannot sustain the fiscal levels that we see now and cannot service our debt and continue to honor obligations to the American people. Thank you for being here, and I yield back.
Gentleman from New York, Mr. Torres, recognized for 5 minutes.
Thank you. Madam Secretary, I have concerns about the signs of volatility at the New York Community Bank. New York Community Bank is the largest multifamily portfolio lender in New York City, with more than $37 billion in multifamily loans. By way of contrast, Signature had far less, $15 billion in multifamily loans. And so a crisis at New York Community Bank would not only destabilize the banking system, it would destabilize the largest multifamily housing market in the United States. Do you share these concerns, and how closely are you monitoring the situation at New York Community Bank?
Well, we are in touch with supervisors, and we are monitoring current banking stresses carefully. I don't want to comment on the situation of an individual bank, but, you know, commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system. And this is something that requires careful supervisory attention.
And so is it fair to say that you as Treasury Secretary, that you're prepared to do whatever is necessary to prevent a second wave of bank failures?
Well, I don't want to get ahead of where we should be given what's happening. And I don't want to comment on the individual situation here, but you know, as Treasury Secretary, I would work with the banking supervisors to make sure that we addressed anything that looked like it could create systemic risk.
There's been considerable reporting about the rise of private credit. I'm wondering if we are seeing in the American financial system the paradox of more regulation having the unintended consequence of causing less regulation. So specifically, to what extent has the intensive regulation of banking in America led to the emergence of a largely deregulated shadow banking system?
Well, I mean, that naturally happens when one carves out an area to regulate that there's an attempt to move activity outside that regulatory system, and perhaps private credit is an example of that.
So if that is true, to what extent will Basel III accelerate that trend?
Well, it's conceivable that it could, but it's also, it's important, and FSOC in part exists to make sure that we're looking not only at banks, but
are we managing risk or are we transferring risk?
We're making sure that there's adequate regulation to address risks that could have spillovers that threaten economic performance and the entire financial system.
The PWG report proposes something resembling banking regulation for stablecoin issuers. Unlike a bank, a stablecoin issuer has no lending and no fractional reserves. And so if a stablecoin issuer operates differently from a bank, why not regulate it differently from a bank?
Well, perhaps it should be regulated differently from a bank, but nevertheless, it's necessary to regulate the risks to make sure that the deposits are channeled into safe assets. You know, perhaps the capital standard should be different, and you know, other features of its regulation should be appropriate and different. It's something more like a narrow bank, but that it should be regulated because it inherently has run risk very similar to banking organizations.
The single greatest powder keg in the world is the Taiwan Strait, where a PRC invasion of Taiwan or a blockade could conceivably cause the gravest global catastrophe since World War II. According to Bloomberg Economics, the cost of a war over Taiwan would cost $10 trillion, 10% of global GDP. It would exceed the cost of the global financial crisis and the global pandemic. Does the Treasury Department conduct economic and financial simulations or war games to determine the impacts of a possible conflict and determine what actions that we as a country should take in advance to mitigate those impacts?
Well, the National Security Council and the interagency, I don't want to detail steps that they've taken, but certainly the risks from the Taiwan Strait have commanded their attention and preparation.
Thank you.
Before we continue, we have approximately 25 minutes remaining. There's a clock for both members and for the secretary. We have a hard stop at 1 p.m., and we intend to honor that within a minute or two or three or so. So with that, gentleman from South Carolina, Mr. Timmons is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Secretary Yellen, for being here today. You've stated that FSOC believes a congressionally approved regulatory structure would help improve the digital asset sector. This year's FSOC report also outlines several vulnerabilities in the digital asset sector, including the lack of consumer protection. Does the current lack of regulatory structure make it harder for consumers to tell the difference between quality products and crypto scams? And how do you believe regulatory clarity will help mitigate risk to the consumer?
So I believe there are some risks to the consumer. We haven't made recommendations to Congress about those. And I'm not sure. I think the CFPB and other agencies, the SEC has some authorities, regulatory authorities in this space that they can use.
But it seems that there's some confusion and there's a lack of clarity. Do you believe that if Congress were to act, it would improve consumer protections?
I'd really need to know more about the specifics.
Okay. The FSOC report repeatedly states the health and resiliency of our banking sector, yet our federal regulators have arguably proposed the largest increase in capital requirements since Dodd-Frank. My colleague, Vice Chair Barr, has already hit on concerns related to Basel III. However, the regulators have also introduced several other proposals, such as the long-term debt proposal and resolution planning requirements. Given such vast proposals, there must be a potential for negative impacts on our financial systems and their ability to operate in a safe and resilient manner. So my question is this: has FSOC reviewed the long-term debt proposal as well as the numerous proposals the banking regulators have put forward?
Well, FSOC does not engage in regular reviews of banking regulations that are within the authority of the banking regulators. They're charged with achieving safety and soundness and putting appropriate rules in place. And FSOC, of course, is supportive of those general efforts, but not involved in a review of agency proposals.
Well, I think the agency proposals are missing the mark across the board, but we will move on to China. This administration seems to be so focused on regulating the American economy out of existence in the name of climate change, yet it is completely turning a blind eye to clear and present dangers presented by the CCP. In fact, the FSOC report mentions the word climate 136 times, which is close to 10 times more than China. Additionally, 2 subsections of the report are dedicated to climate risk. You failed to mention China in your testimony while citing climate risk as the second highest priority issue for FSOC. On top of all that, this past summer, you visited China, and yet another signal of this administration's meager approach towards our communist adversaries. I just feel like we're asleep at the wheel with the biggest risk to the system barreling toward us. It's unfathomable to think that we are allowing the CCP to expand its footprint in our financial sector, whether it's allowing CCP-backed broker-dealers to operate in the U.S., allowing FINRA-registered agents to be based in mainland China, or simply encouraging broad foreign investments. We are empowering the same country that seeks to undermine us at almost every step of the way. Imagine the security risks or threats that could be developed utilizing American financial data or trading trends. It's a national security concern that could undermine the stability of our financial sector, and it's not being talked about enough, and your report is only further evidence of this. My colleague across the aisle just mentioned the impact of China invading Taiwan, $10 trillion, huge hit to the global economy, and I just think that this is a concern that we need to take seriously, and if we're gonna be talking about climate risk, China is the #1 polluter on this planet by far, and we need to hold them accountable if we're going to tell our economy that it needs to take precautions as well, because at the end of the day, we need to be competitive in the global economy. And by adding additional layers of regulation onto U.S. businesses, it impedes their ability to impact in the global economy. And with that, Mr. Chairman, I'm going to yield back. Thank you.
Gentleman yields back. We go to the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you for joining us, Secretary Yellen. On August 23rd of last year, I sent letters to the CEOs of the 5 largest banks in the United States: JP Morgan Chase, Bank of America, U.S. Bank, Wells Fargo, and Citi. I sought detailed information on the status of the pledges they announced in response to the global movement for Black Lives in 2020 following the murder of George Floyd. Collectively, the 5 banks pledged more than $32.5 billion towards investing in racial equity. Although the racial wealth gap is over $10 trillion, it was encouraging to see the banks take this step. For generations, there has been the intentional refusal of mortgages to Black residents, the systemic denial of loans to Black entrepreneurs, and the wholesale redlining of Black neighborhoods. I truly believe that the banking industry has long contributed to the problem and must now work toward the solution. When I told this to the CEOs and requested an audit, I received a response from each of the 5 banks. For months, my team poured over hundreds of documents. It's clear that the banks have made progress to fulfilling their racial equity promises in many areas. Unfortunately, there has been little to no progress in the category of institutional policy changes. This category is focused on the internal policies of a bank, not just the external investments. It includes things like eliminating overdraft fees, expanding language access, opening physical branches in Black communities, and promoting Black people to the highest leadership levels of the bank. Our final analysis is that steps have been taken, but not enough. We need long-term change, not just one-time investments to root out racial injustice in the banking industry. Secretary Yellen, when financial institutions perpetuate and benefit from racism, discrimination, and the exploitation of Black communities, they exacerbate systemic risk in our financial system. The FSOC Analytic Framework for Financial Stability Risk, published last November, pointed out that risk to low-income, minority, and underserved communities can become serious enough to pose a threat to financial stability. For example, the 2007 to 2009 financial crisis, we saw how decades of redlining made Black communities more vulnerable targets for subprime mortgages. In light of this, and I hope this is a simple yes or no answer, Secretary Yellen, do you agree that racism and racial inequity is a threat to the financial system?
Well, it could be, and it is one of the factors that Dodd-Frank told us to take into account in considering designations.
I'll take that as a yes, very good. And to follow up on that, what steps is FSOC taking to monitor and mitigate the threat that racist practices and policies perpetuated by banks can pose to the financial system?
Well, individual supervisors of banks are responsible for ensuring, for example, that CRA requirements are met by banks, and the CFPB has authority to make sure that our fair lending and other laws are obeyed.
All right. Okay. Well, just as I close here, Chair McHenry, in previous Congresses, this committee held hearings with the largest financial institutions in order to allow members to directly ask them questions on the record. This, of course, is in recognition of the bank's outsized role in our economy and our congressional responsibility for proper oversight for the American public. Mr. Chair, will you convene a hearing with the CEOs of the largest banks?
Will the gentlelady restate her question?
Yes. I wanted to ask if you would follow the esteemed tradition and efforts of Ranking Member Waters and do a hearing with the largest banks so that we could ask them questions on the record and conduct proper oversight, given the outsized role they play in the economy.
It was the chair's decision that it was easier just to watch the Senate do that hearing rather than to hear the second day of the same testimony. So that's why the chair did not do that this year.
All right. Okay, well, that's my time. Thank you, and I yield.
Gentlelady yields back. We'll now go to the gentleman from Wisconsin, Mr. Stile, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for being here, Secretary Yellen. Over the course of the next year, it's estimated about $10 trillion in U.S. debt will be reissued, most likely at a higher interest rate. Have you calculated the financial impact of reissuing those $10 trillion at a higher interest rate would be?
I mean, I don't have a number for you at my fingertips.
But do you model that, I assume, at the Treasury, the implications that would have?
Yes, and I think OMB does, and it would be part of the projections that would be included in the budget.
Is the United States reissues in the neighborhood of $10 trillion in debt? Do you have concerns at all about the ability to issue those debt, to find buyers for that debt?
We have very deep, robust markets, and very robust demand for our debt.
So you do not have concerns about a weakening demand with the volume of issuance of $10 trillion at this time?
We take steps to make sure that we issue in a way that is predictable and orderly and keep the markets well informed about our plans, and have had great success in issuing our debt and maintaining liquid and deep treasury market.
But $10 trillion would be the largest issuance of debt the United States has ever seen in a given year by a significant amount. Is that accurate?
I believe so.
So I appreciate your comments. I'd hope that you keep us abreast if you have any concerns as it relates to the demand on the issuance of debt at the volume that the United States is doing, and then the carry costs associated with higher interest rates as this new debt is issued. Let me shift gears with you if I can. I'm concerned about U.S. enforcement of sanctions with Iran. Not only is it the number of sanctions that are in place, but it's also our ability to actually enforce those sanctions and take action upon them that can actually alter the behavior of countries, and in particular, in this case, Iran. I'm uniquely concerned about the lack of enforcement as it relates to oil sanctions with Iran. And as we look at the target of Iranian oil revenues, has Treasury sanctioned any of the Chinese entities purchasing Iranian oil products? And if so, how many?
I'm not aware that we have, but we have certainly tried to stop those oil shipments by sanctioning shippers and others involved with them.
So you've sanctioned some. Should we be looking at the ultimate purchaser of the oil, which in many cases is China? I mean, you said you haven't implemented any sanctions vis-a-vis China, which is obviously one of the largest buyers of Iranian oil. Is that something of concern?
I'll need to get back to you on that.
I think I would love to have you follow up. I have grave concerns about the amount of money flowing into Iran. And in particular, we
certainly do.
Right, I appreciate you sharing that concern. I think we look at the sanctions that have been put in place by the United States, but it's truly the enforcement of those sanctions, in large part at Treasury under your leadership, that is so essential to be able to change the behavior of Iran, which continues to threaten U.S. troops in the region, as well as our ally, Israel. Treasury officials are in China this week, and reports indicate that you're considering a visit later this year. Would you be willing to raise this issue with Chinese officials, either through through people who currently work at Treasury or through yourself, if you choose to take a visit to China?
I will discuss it with people at Treasury.
Would you be willing to discuss it with your Chinese counterparts?
I want to understand the issue and concerns around it before I make any such promise.
Fair. I'd appreciate you looking into that, because I think it's something that is absolutely worthy of your time, and you've been vested in great power by Congress with the ability to enforce a lot of these sanctions and our ability to deter Iran from their continued funding of terrorism is really dependent on the action of Treasury under your leadership. How would you respond to concerns that China should not receive a high-level visit if it's purchasing oil from Iran? Do you think that should alter a decision by you or others from Treasury to engage and visit China?
We have many differences with China and concerns about its behavior, but President Biden and President Xi agreed that we should talk to one another and create channels for exchanging information and sharing our concerns and discussing them. It's a way to stabilize our relationship, and my dialogues with my Chinese counterparts are intended to do that. I have very honestly and thoroughly in past engagements explained many issues that concern us about China's economic behavior.
Thank you. I yield back.
Gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and to the ranking member. Good to see you, Secretary, and appreciate you appearing here to discuss the recent report from the Financial Stability Oversight Council. It's a great opportunity to have you here today because since we last spoke about your leadership and how it was instrumental in successfully restoring stability to our banking sector, promoting economic growth far beyond expectations, and adding a staggering 225,000 jobs a month, 3.1 million total in 2023 alone, the year covered by your report. Critically, there was not just growth in the number of jobs created, but the quality of the jobs is rising as well. Americans are finally seeing their incomes climb, and now not only is the level of real annual earnings higher than before the pandemic, but in 2023, the growth of real wages was faster than it was during the pre-pandemic trend. Everyday working families, those earning in the bottom 25th percentile of workers, saw the fastest expansion with a 3.2% jump in their inflation-adjusted incomes. So I want to commend you and the Treasury Department for your invaluable efforts in contributing to this strong growth, as your efforts to mitigate the contagion of a bank run earlier in the year were largely successful. Importantly, the growth in real wages was also concentrated in communities that have historically fared poorly during times of economic recovery, with specific gains being made for Black and Hispanic workers who saw their earnings grow 4% and 2.4% respectively. As you mentioned earlier this year to the Economic Club of Chicago, and according to the Treasury Department's October Equitable Recovery Report, this may have even been the most equitable recovery in recent history. Now, while I recognize that these gains were far better than forecasters predicted, I hope you'll agree with me that there's still more work that needs to be done. While House Democrats and President Biden are working to ensure we all have a chance to succeed, recently we've seen an extreme conservative movement begin a new assault on the lending firms that aim to expand access to historically underserved communities. Far broader and equally as sinister has been the rapid escalation in attacks on diversity, equity, and inclusion initiatives throughout our economy in the wake of last June's Supreme Court ruling on affirmative action. Given these actions against institutional efforts to address longstanding inequities, it is more important than ever that we speak up to protect Black and minority entrepreneurs and their access to the limited capital that is available to them in the first place. The organizers of the latest attacks are organized, they're determined as they work to undermine our efforts to make a more inclusive economy. But rest assured, we will be equally as resolute in our defense, and we will not be silent. The baseless attacks on these efforts harm everyone, as we know that diversity, equity, and inclusions are a business imperative. In fact, I want to enter into the record a report from McKinsey and Company titled Diversity Matters Even More, where they report that the companies with the most diversity in their management team in the top quartile have 39% better performance than those that are not diverse. So Secretary, thank you. Secretary Yellen, as Treasury weighs key policy priorities such as the Community Reinvestment Act, the IRA and CHIPS implementation, and other determinations, do you agree with the McKinsey report findings that companies and financial institutions that refuse to incorporate diversity, equity, and inclusion practices into their businesses perform worse than their peers and thus may be riskier?
Well, I'm aware of the research that you cited, and it strikes me as being well done. So while I've not looked at this issue myself, I see very good reasons for the findings you mentioned.
Thank you. And do you believe that these renewed attacks on diversity, equity, and inclusion efforts may lead financial institutions to lower the availability of credit to low-income, minority, and underserved communities? And could these pullbacks increase systemic risk within those communities if those institutions are a main source of credit for those underserved populations?
Well, I think access to credit is critically important for these communities, and it would be a devastating thing to see a pullback. As you know, Treasury and the Biden administration have been highly focused on adding through many different programs, including CDFIs and this SSBCI program, access to capital in minority,
Thank you.
low-income.
And for that reason, Mr. Chair, I add with my colleague and call on you to bring a hearing on this important issue. This is an attack that must be addressed, and this committee should be at the center of it. With that, I yield.
Gentleman from Pennsylvania is recognized for 5 minutes. Mr. Muser is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Secretary, great to see you, Secretary Yellen. A little while ago, you had an exchange with Mr. Cass and about the employment numbers and unemployment numbers, and you stated, I believe, if I heard it right, that the situation of the number of illegal migrants coming into our country, I believe you said was a positive thing. Did I hear that right?
Well, I said that I didn't speak to, did you say illegal immigration?
Yeah.
I didn't speak to illegal immigration.
Okay, well, that's what he was referencing. He was referencing the level of migrants coming into the country, and
I simply said that immigration that's added to our
because legal immigration is great. Illegal,
I'm
drugs,
I don't really
human trafficking.
Not weighing in on that.
All right, thank you, Secretary. So the FSOC's recent guidance on climate change, non-bank SIFI designations, the Basel III endgame proposal, have received wildly overwhelming criticism by the financial industry for being unclear, overly broad, all kinds of descriptions. Creates confusion, not being data-based. And we've had conversations with Vice Chair Barr and many others, Chairman Powell, related to this, so that's certainly nothing new. Yet the regulators are not conducting cost-benefit analyses for each rule they implement. The guidance on non-bank SIFI designations, climate change, and the Fed's Basel III endgame omits any any cost-benefit analysis. So, Secretary, why do you believe any business subject to non-bank SIFI designation should not receive a cost-benefit analysis to determine the effects on the business?
Well, FSOC was given by Congress the ability to designate a non-bank whose materials distress would pose a risk to the financial system. And most clearly, FSOC did not require a cost-benefit analysis in association with that. That's something that they could have done and chose not to do. And there are very good reasons not to do it, because what we're talking about in terms of the benefits of designation is a reduced chance of a financial crisis. And to try to quantify exactly what are the costs of a financial crisis is not a useful exercise. Even in the aftermath of financial crises we've experienced, like the 2008 crisis, people can't agree what the cost of it was.
Just because it's not in the rule doesn't mean it wouldn't be worthwhile, and they could pursue it anyway to gain a more accurate finding and outcome. But let's just talk about Basel III endgame for a moment. No cost-benefit analysis, not much data to support it. Small businesses across the country will suffer from it because there'll be less lending taking place. Nobody can argue that. Some people say it could be as much as 20% from the big banks, and then all kinds of pressure is put on the smaller banks, where they will have, instead of 20 small businesses coming to them, they'll have 100 because there's less funding and capital available from the large banks. Yet some people argue those very basic, simple, fundamental points. So I ask you on Basel III, I mean, are you concerned about the feedback, the overwhelming feedback regarding the problems and potential risk to our economy that the Basel III endgame proposal will cause?
So the banking agencies put out this proposal. This is not something that I've been involved with, and they've received many comments and expressions of concern along the lines that you've just indicated, and it's their job under the APA to review those comments and to respond appropriately.
Okay.
My understanding is that they believe that changes in some of the proposals are going to be appropriate and necessary to address the commenters.
Thank you. And as Secretary of Treasury and all the things you've done in the past, is there a plan in place to help American business become more competitive besides spending in an excessive manner, which some argue creates an artificial growth initiative?
Gentleman's time's expired. The Secretary can respond for the record. We have one final questioner, and in consultation with the Secretary's team, she's game for it. Nice day of endurance here. With that, we'll now recognize the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Madam Secretary. I'm the last member, I guess. So. When Fannie Mae and Freddie Mac were taken into conservatorship in 2008, Treasury received warrants that give it the right to buy common stock in each of the GSEs equal to 80% of the total outstanding shares. And those warrants expire on September 7th of 2028. In August of 2020, the Congressional Budget Office issued a report that estimated Treasury could receive the $190 billion for its senior preferred shares in addition to $110 billion from exercising its warrants in the GSEs. FHFA Director Thompson said in hearing last May that the two of you have not discussed these warrants. The conservatorship has gone on, I think you could agree for probably too long now. And I'm concerned that the conservatorship of the GSEs and the warrants could be used to further politicize the entities. Have you or your staff given any consideration to the monetization of Treasury's warrants in the GSEs?
This is not a matter that I'm up to speed on. I'm not knowledgeable about this. I have a staff that spends a great deal of time thinking about it, but I've not had a discussion with them about this. I would appreciate it if I could get back to you on this matter.
Absolutely, I appreciate it. Thank you. Secretary Yellen, last May you said this might be an environment in which we're going to see more mergers, and that's something I think the regulators will be open to if it occurs. But I think, as a member of the committee, the perception out there is that regulators review kind of the proposed bank deals at a slow pace. And there is also a relatively high degree of uncertainty about the outcomes, both of which have kind of this chilling effect that we've had reported right here in the committee. So given the regional banks are subject to constant on-site supervision, we've heard from the bankers about this numerous times, can you think of any reason why it should take the Federal Reserve more than the statutory prescribed 90 days to decide if a merger is appropriate under the Bank Holding Company Act?
So I could just say, based on my own experience in the Fed, that often issues are raised in connection with the community performance of banks that need to be investigated. And these investigations can involve a lot of back and forth and be time consuming. And so I shared your frustration that it often took a good deal of time, but sometimes there are difficult issues that need work to respond to before a proposal can be presented to, in the Fed's case, the board.
Very good, thank you. Saudi Arabia pricing their barrels of oil in dollars has played a large role in the U.S. dollar building and maintaining its status as the global reserve currency. The Saudi Minister of Finance stated that they are open to trading oil in currencies other than dollars and has held talks with China. I'm not sure if you're aware of that, not asking you that question. Combined with the de-dollarization efforts by adversaries like China, Iran, Russia, to evade sanctions. The potential weakening of the dollar as a global reserve currency is concerning. What are some of the actions Congress can take to maintain the dominance of the dollar and ensure we can maintain effective sanctions?
Well, the dollar is valued as an asset because of the deep and liquid treasury market that we have, the strength of the U.S. economy, and the strength of our currency, and the fact that we keep inflation under control and it's a good investment. We have rule of law, we have open capital markets, and protecting these fundamental assets that give rise to the strength of the dollar is critical to its role. But the important role of the dollar also enables us to levy sanctions against countries that act against our interest, and by depriving them of access to the dollar financial system, we can really exercise some control over their behavior. And it should be understood to be natural that when we use sanctions, that those who are sanctioned are incented to try to figure out workarounds. I've not seen anything that I believe poses a deep threat to the dollar, but those incentives exist, and our ability to sanction countries' activities that threaten our national security, I think, is very important.
Gentleman's time has expired. Secretary Yellen, and I ask for your forgiveness. We're now 8 minutes past the time. In order to have partisan balance, Ms. Tlaib is here, and I think it would be appropriate if we can allow her to ask 5 minutes.
I certainly will.
We did start a few minutes late, so thank you for that, Secretary Yellen. We'll go to Ms. Tlaib for the final set of questions for today, then we will adjourn immediately after.
Thank you so much, Mr. Chair. As you know, Secretary, non-bank financial companies like AIG, Lehman Brothers played a large role in the 2008 financial crisis. That crisis disseminated the U.S. economy, causing millions of our families to lose their jobs, their homes, or both. And I know in my district, including Wayne County and broader southeastern Michigan, I mean, we saw employment fall 51% for low and moderate income households. The median home value for low and moderate homes plummeted like 53%. Countless families, as you know, lost their homes to foreclosure. We had the worst tax foreclosure crisis in Wayne County. When the pandemic hit, another financial crisis emerged seemingly overnight, and again, liquidity pressures on vulnerable and over-leveraged shadow banks contributed to the market volatility. The risks posed by such companies have not been addressed. Today, non-bank financial intermediaries, I think they call them, broadly defined, are responsible for 60% of credit provided to the U.S. economy. And so, Secretary Yellen, can you discuss the size of the so-called shadow banking sector and its interconnections with the traditional banking sector?
Well, the shadow banking sector is very large, and we are very focused on potential risks. I agree with your assessment that much of the damage, not all of it, but much of it during the financial crisis arose from this so-called shadow banking system. And in part, FSOC was created in order to try to address those risks. So it is very high on our agenda. We have a variety of tools to do so, and we've identified a number of areas that give us concern. Some of those were the areas, as you mentioned, in March of 2020, where we saw problems. And there were open-end bond funds.
So, Secretary, but given the size of non-banks, their interconnectedness, the incentives they face, I greatly appreciate your leadership in establishing FSOC's new guidance on the designation of non-banks as systematically important. I completely agree. The question now turns to implementation, which implementation matters. So, Secretary, so 0 non-banks are currently designated as systematically important. Do you believe that no non-bank financial institution is systematically important?
So very often, the financial stability risks are not created by an institution, but rather by market-based practices within a market. For example, money market funds have been a problem both recently and in the crisis. And to deal with those risks, it's not appropriate to just choose one or two large money market firms, money market funds to designate. I don't think designation is the right tool. I think an approach that regulates the practices in the industry is appropriate. So the so-called activity-based approach, that is what the SEC has been pursuing in that space. Sometimes it is appropriate to designate a firm when it creates risks, but in other situations,
I know, it's just, what I hear is the different regulatory environments that we're creating. I mean, what does it mean? What is regulatory, was it arbitrage? What does that mean?
Regulatory arbitrage means that when one sector is regulated, that a kind of activity that becomes more expensive to conduct through that sector moves to a less regulated part of the economy. But this isn't always about individual firms. It's often about a group of firms or an industry.
Or maybe a culture.
It might be a culture, but often it's many firms and not just one or two firms that are responsible for the problems.
And I just want FSOC, of course, it was important for you, and thank you for your leadership on that, but it has to fulfill its total responsibilities when it talks about protecting our residents, especially our low-income and underserved communities from the systematic risk, as you know, and financial instability that result from the failure of the mega banks and financial. So describe, I mean, what specific actions, maybe you talked to some of my colleagues about this already, has FSOC really taken or plans to take in full responsibility in protecting those families? Again, I'm looking at these and trying to learn about these processes in the culture as I create it, I call it.
Gentlelady's time's expired, and if the Secretary can answer for the record in writing, that would be sufficient.
Okay, I will answer for that.
I want to learn more. Thank you.
Thank you, Secretary Yellen, for your testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair. These will be forwarded to the witness for her response. I want to thank you, Secretary Yellen, and please respond to these if you would, no later than March 30 of 2024. This hearing is adjourned.